Namaste, good morning. Welcome to this session where our primary intention is to complete capital gains, IFOS, deductions, and walk into, to a larger extent, assessment of firms. Well, we are continuing our discussions on capital gains. We are continuing our discussions on capital gains. Okay, to a larger extent, we saw how to compute capital gains, what are all the intricacies involved in various aspects. The various aspects include, okay, what will be the full value of consideration in various circumstances, what will be the cost of acquisition in various circumstances, how the numerator and denominator of indexation changes, what is the importance or what is the beauty of Manjula Jesha case law. All these things we were looking into. We were looking into from various perspectives, from the perspective of company, from the perspective of shareholder, from the perspective of slum sales, etc. Today, we move on to exemptions. Before moving on to exemption, starting from today till the date of your examination, we are going to have small test, very small tests. Okay, shouldn't take more than 30 minutes or so is my opinion. Let's see. Starting from today, I'm planning that, and it will go on. Even after classes, it will go on. I will tell you the whole plan of action for that later. Now, I am starting with exemptions from capital gains. The law uses the terminology exemption from capital gain. I am broadly dividing the exemption into two. Exemptions which are available for domestic assessees, or I will call it as non-business assessees. Only individuals and HUF. I'm not saying individuals and HUF who are doing business cannot claim it, but basically these exemptions are for non-business assessees, and then exclusively exemptions for business assessees. Some exemptions fall in both the part. So let us call it as individuals and HUF can claim these three things. Only individuals and HUF can claim these three things. 54. Sell a house property, buy a house property. What is transferred is also a house property. What is invested is also a house property. 54B. Sell a agricultural land, buy another agricultural land. Sell agricultural land and buy another agricultural land. 54F. Sell any asset other than house property and purchase house property. The difference between 54 and 54F. 54. What is transferred is also house property. What is invested is also house property. 54F. What is transferred is other than house property, any asset. What is invested is house property. Let's understand 54 because many part of 54 will be applicable to 54B also and 54F also. What is 54? As I told you, sell a house property and purchase another house property. The asset transferred should be a long-term capital asset. So 54 is only for Lpcg. The asset transferred should be a long-term property and it should be a house property. Okay, it should be a house property and it should be a long-term. Assessee should have purchased 1 year before or 2 years after. Within 1 year before. Many times what we do, we find a good house property. We are yet to sell the existing house property. So we book it, we block it, we purchase it and then sell the existing house property. So that is a possibility. So law recognizes that. Purchase can be 1 year before or 2 years after the date of transfer, whereas the construction should be completed within 3 years. The construction should be completed within 3 years and never transfer the new property within 3 years. Don't do it as a business. Don't do it as a habit. Don't do it as a routine. Okay, do not transfer the new property within 3 years. So shall I? What is transferred is a house property available for individuals and HUF. Asset transferred should be a house property, should be a long-term capital asset. Assessee should have purchased or invested in another property within specified time period. Purchase 1 year before or 2 years after the date of transfer. Investment construction 3 years. Construction should have been completed within 3 years and the new house property should not be transferred within 3 years. Now the biggest problem we all know is, suppose I sell it in December, January, or even if I sell it on 1st of April also, I have to file my returns before July, but whereas I will have time for construction 3 years and for purchase 2 years. But I have to file my returns before July 31st. Majority of this are individuals and HUF. So I have to file my return before July 31st. I would not have invested. How to? The law says, prove your intention of investment. The law says, prove that you have the intention to invest. Once more, law says, prove that you have the intention to invest. How to prove? Keep it deposited in an account, CGADS, Capital Gain Account Deposit Scheme. Once more, CGADS, Capital Gain Account Deposit Scheme. Keep it invested in that account. CGADS, that is the account. Keep it invested in that account. By investing, you are proving your intention. By investing, you are proving your intention. So, deposit the money in CGADS before the due date of filing returns and use that money for purchase or construction. What is the quantum of exemption? Listen first. What is the quantum of exemption? Here, law makes a differentiation between a small assessee and a larger net worth person. If the long-term capital gain, gross gain is up to 2 crores, once more, if the gross gain is up to 2 crores, invest in 2 properties also. If the gross gain is more than 2 crores, you are allowed to invest only in 1 property, or exemption is available only for 1 property. Repeating. If the gross gain is more than 2 crores, investment can be in 2 properties. Gross gain more than 2 crores, investment can only be in 1 property. Amount invested or actual long-term capital gain, whichever is less. If you violate any of the condition, what are all the conditions? Don't sell off the new property within 3 years. Keep the money deposited in CGADS and utilize it for purchase of construction. If you sell the asset within 3 years, or if you don't use the money, or you withdraw it and use it for some other purpose. If you sell the asset within 3 years, non-utilization, misutilization, the exemption already granted will be withdrawn. The exemption already granted will be withdrawn. We will go ahead and understand section 54. Available for long-term house property transfer of purchased 1 year before or 2 years after, or construction completion within 3 years, new house property. Do not transfer the new house property within 3 years. If you transfer, the exemption already provided will stand withdrawn. If the assessee is unable to immediately invest, but has intention to invest, keep the money deposited in CGADS. Deposit to be made on or before the due date of filing returns. Okay, keep the money deposited in this capital gain account deposit scheme. If deposited money is withdrawn and not used, it is taxable in the year of withdrawal. Deposited money unutilized, taxable at the end of 3 years. Quantum. If the gross Lpcg does not exceed 2 crores, amount invested up to 2 houses you can claim. Where the gross Lpcg exceeds 2 crores, you can invest or you can claim for only 1 house property, even though you have invested in 2. Okay, even though you have invested it in 2. Read through 54. It will be following in 54B and 54 also. Right? Asset transferred should be a long-term house property. Assessee should have purchased or constructed a new property within specified time, and the new property should not be sold. Invest in CGADS before due date. Actual amount or amount invested in 2 house or 1 house as the case may be will be exempt. If you violate condition, it becomes taxable. 54B, transfer of agricultural land. Remember, how do I call as an agricultural land? In the immediately preceding 2 years, you should have used it for agricultural purpose. It cannot be a land, agriculture land 10 years before, 15 years before and all. It should be a live agricultural land in the sense should have been used for agricultural purposes in the immediately preceding 2 years. Then only I will call it as agricultural land. Assessee should have purchased another agricultural land and do not transfer it within 3 years. If you transfer, you will get the taxation CGADS as above, as like 54. Here is the catch point. Gross capital gain. This is also available. Here you can see it is gross Lpcg. Here you can see it is gross Lpcg. Whereas this 54 alone is talking about gross capital gains, which means it is also available for STCG or amount invested, whichever is less. Read through. 54, 54B, and the last and the third one to understand in this is 54F. What did I say about 54F? Sell any long-term capital asset other than house property. If you sell house property and buy house property, 54 is there. Here, transfer any long-term asset. It should be a long-term. So only for LTCG, it can be jewelry, it can be shares, it can be vacant land. Okay. Shall I repeat? It can be jewelry, it can be vacant land, it can be even agricultural land sales and buying house property. It can be shares, anything. Investment is in house property, same time period, and do not transfer within 3 years, same CGADS benefit. The condition, the exemption is formula based. If the whole net consideration is invested, fine, claim the whole capital gains. Shall I repeat? If the whole net consideration is invested, claim whole capital gain as exempt. Otherwise, proportionate. Gross LTCG into amount invested divided by net consideration. Gross LTCG into amount invested divided by net consideration. 54F alone, I will not give for a person who is already owning 2 house properties. In the sense, as of today, you don't own any house property. You sell jewelry, buy house property, take 54F. As of today, you already own one property. As of today, you already own one house property. Still, you sell jewelry, buy another house property, take it. Take it. 0 to 1, take it. 1 to 2, take it. As of today, you already own 2 house properties. No more 54F for you. No more 54F for you. Exemption cannot be claimed by assessee who already own 2 or more properties. Once read through the table. Okay. Another section which is available for non-business as well as business assessees. Not only just for individual, but for all assessees. Exemption available for all assessees. Very popular exemption. Section 54 EC, investment in specified bonds, which are nothing but bonds issued by National Highway Authority of India and Rural Electrification Corporation. Okay, so you can understand it as investment in bonds of NHAI and REC, investment in bonds of NHAI and REC. Asset transferred should be land or building. Please remember, what should be transferred is land and building, and it should be a long-term capital asset. Asset transferred should be land and building, and it should be a long-term capital asset. Repeating, asset transferred should be land and building, land or building, and it should be a long-term capital asset. Invest in specified bonds. Specified bonds is bonds issued by NHAI or bonds issued by REC. Make the investment within 6 months. Make the investment within 6 months. Ensure that you make the investment within 6 months and do not transfer it for 5 years. Do not transfer it for 5 years. Okay, if all these conditions are satisfied, gross Lpcg or amount invested or maximum 50 lakhs, whichever is less. The exemption is gross Lpcg or amount invested or maximum of 50 lakhs, whichever is less. So, here what you should remember is, don't get only it should be for land and building. Okay, and it should be a long-term capital asset. Not for all assets, land and building, and it should be a long-term capital asset. Before going into the business deductions, exemptions, I once again repeat 4 sections which we have studied. 54, sale of a house property, buy house property, only long-term capital asset, up to 2 crores, invest even in 2 houses, exceeding 2 crores, only 1 house. 54B, sell agricultural land, buy agricultural land. 54 EC, sell land and building, long-term capital asset, buy bonds, maximum is 50 lakhs. 54 F, sell any long-term capital asset other than house property, buy house property. Exemption is formula based. Now, my dear friends, so I sell any asset, buy house property or buy agriculture, whatever it is. Can the assessee buy in joint name? Mr. X sold the property and purchased the property in the name of Mr. X and Mrs. X. Purchased the property in the name of Mr. X and his son. Assessing officer said, no, I will not give you full exemption or I will only give you proportionate exemption. The court said no. The intention of investment, if it is satisfied, the intention of investment, if it is satisfied, we need to provide the exemption. Once more, if the intention of investment is satisfied, we need to provide the exemption. Gurnam Singh. Whether the property in his name and in the name of the associate and his son will qualify. Ravindra Kumar Arora. Whether property in the name of associate and his spouse qualify. Amal Vahal. Whether property exclusively in the name of associate spouse will qualify. In all the three cases, favorable judgment to the associate. In all the three cases, assessee favorable judgment, which means it qualifies and you can get the exemption. In all the three cases, assessee based judgment held by the High Court that the property in the name of assessee and his son will qualify for exemption as the conditions are fulfilled. Held by the High Court that the property in the name of assessee and his spouse will qualify for exemption, okay, as the condition is fulfilled. Held by the High Court that a property exclusively in the name of the assessee spouse will also qualify as the condition is fulfilled and the assessee continues to be the deemed owner of the property. So, the investment can be in the name of assessee and spouse, assessee and son, sometimes exclusively spouse name also, because assessee is the deemed owner of the property. Sir, you said in section 54, purchase can be 1 year before or 2 years after. Construction should have been completed within 3 years. Sir, I constructed the new property. I constructed the new property even before selling off my present property. Construction commenced before. Purchase 1 year before and 2 years after the date of transfer. Construction should be 3 years from the date of transfer, but I already started my construction. Will the law provide me the exemption? Intention of investment is superior. Ariyama Sundaram. Whether construction before sale of property qualifies. Held by the High Court, the construction can also be prior to transfer. The overall intention of investment should be fulfilled. Everywhere, this is the wordings you see. Section 54 does not make it mandatory to invest the same gain. One-to-one correlation is not there. This capital gain, go and invest. If you invest, even from your savings you might have invested, you will get the benefit. Intention of investment. Everywhere you see that only as the primary. So construction can also be before commencement. Can construction be beyond the 3 years also? The builder is unable to complete within 3 years. Not because of my mistake or I have proved, but due to various reasons, take COVID years, etc. Due to some reason, construction not completed within 3 years. What did I say? Intention of investment is superior. Investment condition has been fulfilled by the assessee, but the procedural aspect of completion is pending. Exemption should not be denied. Exemption should not be denied. Everywhere, what am I saying in capital gains to remember with regard to exemption? Intention of investment. Hindustan Lever case. Sir, within 6 months, they are unable to get the bonds. Where there is no issue of bonds within 6 years, or payment was made before the end of 6 months, but the bonds were issued after 6 months. Held by the High Court that the exemption can be claimed even if the bonds is dated after 6 months, provided the investment criteria is fulfilled. My intention is to make you invest. My intention is not to not anything else. Okay, it's not anything else. Section 54 EC, investment in bonds. Land and building only. It should be a long-term capital asset. Invest within 6 months. Okay, okay. Company sells building which is part of their block, and the capital gain is invested in bonds. Can company claim 54 EC? Company sells a building which has been their part of the block, and there is a capital gain which I invest in bonds. Can company claim 54 EC? AO contended that the gain is STCG. Whenever you sell a depreciable asset, whenever the block of asset ceases to exist, okay, the resulting gain is short term. Because opening WDV less sale consideration. So it is less than 1 year. I am not comparing with the original cost. Okay. AO contended that the gain is short-term capital gain. 54 EC is only for long-term capital assets. So no exemption. AO's contention is you cannot claim exemption. Court gave an extraordinary or mind-blowing judgment. Held. Asset is a long-term capital asset, but the result is a short-term capital. The court said, is the building with the assessee for more than 2 years? Yes. Holding period is different from computation. Holding period is different from computation. Is the holding period more than 2 years? The answer is yes. The holding period is more than 2 years. The building has been there for 10 years. So the holding period is more than 2 years. So it is a long-term capital asset, but the gain is always known as short-term capital gain in the case of depreciable asset because of the methodology of computation. Opening WDV, additions, more 180 days or more, less than 180 days, deletion, the result might be short-term capital gain. A long-term capital asset gives a carbon. Okay, look at the exemption. Exemption is not for Lpcg. Exemption is only for LTCA. So it is a LTCA giving a result of STCG. Hence exemption needs to be granted. So do not deny the exemption. VS Tempo. Assessee sold a depreciable asset and invested the proceedings in specified bonds. AO denied the exemption on the ground it is STCG and 54 EC is only for LTCG, held by the apex court. According to section 50, the resulting gain on sale of depreciable asset is always short term. This does not mean that the asset is a short term capital asset. Classification is different from computation. Classification is different from computation. It is a LTCA giving us STCG. It is a LTCA, but the result it gives is STCG. That's all. One of the important case laws. This is the next case law. Let us take land sold for 50 lakhs. Stamp value 70 lakhs. So which will I take? FVC, full value of consideration, will be 70 lakhs. Exceeds 110%. So full value of consideration is 70 lakhs. Investment for 54F, 70 lakhs. Whole capital gain exempt. Okay. Now understand the case. Assessing officer said, how come you are investing 70 lakhs? Your capital gain itself, your sale consideration itself is only 50 lakhs. You can invest only 50 lakhs. Method of computation is actual sale value or stamp value, whichever is higher. That is okay. But when your actual sale value is 50 lakhs, how come you are investing 70 lakhs and getting the full capital gain exempt? No, I will take it only 50 lakhs. So this is just the notional value. Court said, when you can increase the notional value, why should not the assessee use other sources and invest? Court asked, just now I told you in the Aryamba Sundaram case, should the same capital gain be invested? One-to-one correlation is essential? No. Of course, I sold the property for 50 lakhs, but I know you are going to tax 70 lakhs. I want to enjoy the full exemption, so I invested in the new house property some 70 lakhs. You cannot say, no, you sold it only for 50 lakhs. 50 lakhs can only be invested. No, sir, I have some salaries. I have some other source of income. I took money from there and invested. When you can tax a notional value, why should not I get exemption for that notional value? Gauli Mahadevappa case, the court took a favorable stand to the assessee again. Value of the property was determined as per section 50C. Assessee has invested over and above the sale value. Is he eligible for exemption? Held by the High Court. That when computation is on a notional basis, the benefit of exemption cannot be restricted to actual sale value. How do you do that? Assessee is eligible to claim on money invested from his other sources also. capital gain is not one-to-one correlation. Okay, 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 right. Let's complete some questions here and then travel to business-based exemption. We have completed up to secure question number 10 yesterday. I'm going to question number 11. Krishna inherited his grandfather's land, okay, in May 2013. So inheritance, I will have Manjula Jesha as well as normal working. His grandfather had purchased in the year 1989 for 12 lakhs, fair market value 40 lakhs, whereas stamp value was only 38 lakhs. Krishna sold this in the previous year for 2.75 crores when the stamp value was 3 crores. Compute capital gain. So the mistake I did, own question, the mistake I did while typing is taking it as land. Actually, I should have put it as house property. My intention is it is only house property, but when I typed it as land. I request the class to take this as, okay, house property. It is not just land, it is house property. That is what is my intention. But when I typed the question, I typed it wrongly as land. Request the class to take it as house property. Yesterday, one of our friend was asking me, will I get the highlighted material also? I don't have absolutely any problem in sharing with you. After all, I have prepared only for you people, not for just me. So I will share it. But only thing is, highlight is in for theory. I am using one material. From practical, I am using. I will share both. Clearly naming highlighting of theory, highlighting of practical. Don't get confused with too many materials. But at the end of the classes, I will share it with you. I don't have any problem if you want this highlighted, and wherever I am correcting, that will be there also. So coming back, so kindly understand it, because my intention is 54, but while typing, I typed it as land. Krishna inherited his grandfather house property in May 2013. His grandfather has purchased it before 1/4/2001. FMB as on 1/4/2001, whereas stamp value. Krishna sold it in the previous year for 2.75 crores when the stamp value is 3 crores. Compute capital gain. A. Using the proceeds, Krishna invested in 2 apartments, each costing 80 lakhs. B. If 2 adjacent apartments are purchased and in between partition wall is removed. C. If the properties is registered in the joint name or in the names of the spouse, will your answer change? Full value of consideration, actual consideration is 2.75 crores, 2 crores 75 lakhs. Stamp value is 3 crores. 110% of actual consideration. 110% of actual consideration. Okay. Since the stamp value does not exceed 110% of actual consideration, since the stamp value has not exceeded 110% of actual consideration. Okay, actual consideration will be taken as full value of consideration. So you will only take 2 crore 75 lakhs. You will only take 2 crore 75 lakhs. Since the stamp value has not exceeded 110% of actual consideration will only be taken as full value of consideration. Okay, there is no brokerage and all. Okay, so less cost of transfer is nil. Okay, net consideration. Okay, 2 crore 75 lakhs in both the cases, because the answer does not change here. Okay, the answer now, less ACOA. Okay, before going I will write it. Property is purchased, okay, before 1/4/2001. Hence actual purchase price or FMV as on 1/4/2001, whichever is higher will be considered. And then comes the amendment. However, FMV shall not exceed, okay, stamp value as on 1/4/2001. However, the FMV should not exceed the stamp value prevailing on 1/4/2001. In this case, okay, 40 lakhs or FMV, okay, when 12 lakhs or 40 lakhs, whichever is higher, but this 40 lakhs cannot exceed this 38 lakhs. So I will only consider 38 lakhs into 301 divided by May 2013. May 2013 makes it 1314. 1314 to 20. Okay, 220, year of inheritance. Year of inheritance. Whereas if I follow Manjula J. Shah case, 301 divided by 100, the base year. Okay, whereas which I, okay, so here it is 38 lakhs into 301 by 220, whereas here it is 38 lakhs into 301 by 100. Gross LTCG, gross LTCG, okay, gross LTCG 2 crore 23 lakh 909 if it is as per law, and 1 crore 60 lakh 62,000 if it is as per Manjula J. Shah. Okay, gross LTCG. Up to this, let me know whether it is clear. There are a lot of calculation, lot of understanding. 110% we check, that is also an amendment. This is also an amendment. Exemption under section 54. Exemption under section 54. Exemption under section 54. Please understand, all of us. If I go as per law, my gross LTCG exceeds 2 crores. So exemption can be claimed only for one property, where gross LTCG exceeds rupees 2 crores. Exemption can be claimed only for one house property. So, since my gross two apartments each costing rupees 80 lakhs, so here I can claim only 80 lakhs. I cannot claim for two. I can only claim for one. Where gross LTCG does not exceed rupees 2 crores, exemption can be claimed for two house properties. Okay, here it can be 80 lakhs into 2. 1 crore 60 lakhs I can claim. If I go as per law, I can claim only for one house property. If I go as per Manjula Jesha, we need to work both answers and show. Taxable LTCG, patiently look through. Okay, okay, please understand that. Part B. If two adjacent apartments and in between partition answer is removed, okay, where two apartments are purchased and in between wall is removed or access is given to make it, okay, access is given in between, then it will be taken as one house property even if it is by two sales deeds, even if it is by two sale deeds. One of the benefit the law gives you is, if the in-between wall is removed, not only wall, if there is a door that is sufficient, not only wall, if there is a door that is sufficient, connecting both the houses internally, I will consider it as only one house and not two houses. Okay, I will consider it as only one house and not two houses, even though if it is by two sales deed. So here it will again be 1 crore 60 lakhs, because it will be treated as only one house, where the in-between connecting wall is removed or there is a connection point between the two apartments, that is sufficient to prove that it is one house. Okay, when they sell it, they cannot rebuild and sell it, where they will sell it as one house only, so you will get a bigger benefit. Part C, you all know the answers. Okay, Part C, you can refer to Ravindra Kumar, Arora, Kamal Vahal, okay, any of Gurnam Singh, any of this case laws to understand the methodology. Question number 12. Pqr Manufacturing Limited, a manufacturing company, was transporting its machine from one unit to another unit on 29th November by a truck. On account of civil disturbances, the machine was destroyed. The insurance company paid 22 lakhs for the destroyed machine. On these facts, for submitting the return of income for the previous year, your advice is sought. That destruction of machine result in transfer? How would the amount received in the insurance company be taxable? Will the company be liable to save tax by investing in 54 EC bonds? Part A. Extinguishment of asset shall be treated as transfer. Extinguishment of asset will be treated as transfer. No point, no doubt, it is regarded as transfer. Compensation paid by the insurance company shall be treated as full value of consideration. Shall be treated as full value of consideration. So destruction of the machinery is a transfer, compensation paid is taxable. Part B. How would the amount received? Okay. Compensation received from the insurance company will be reduced from the block value. Okay, opening WDV, additions, deletions. In that you will write insurance compensation received. In that you will write insurance compensation received. Compensation received from the insurance company will be reduced from the book value. Okay, so that will be considered. The compensation will be reduced from the block value, where the block ceases to exist due to such reduction, and the result will be STCG or STCL. Okay, by reducing it, if we saw in one of the question, instead of an individual building 2018, our friend was asking, sir, we don't have that asset, can we still claim depreciation because we have transferred, ownership is gone? We can still claim depreciation. We did for 1890, 1920, and then reduce the block to find out the short-term capital gain. Okay, so the result will be short-term capital gain or loss. Part C. Can the assessee claim 54 EC? No. 54 EC is available only for land and building transferred. In the instant case, it is machinery. So 54 EC cannot be claimed. Okay, but as additional note I write and give, however, if the asset is a LTCA, then 54 EC can be claimed even if the result is STCG. Okay, VS Demco. Okay, in that case we know that it can be, but here you cannot claim because it is a machinery and not land. Question number 12A. Mr. X was the owner of a residential house comprising of 2 floors. In April 2020, he entered into a collaboration with Arihan Builder for developing the property. According to the terms of the agreement, Arihan Building were to demolish the existing structure on the plot of land and develop and construct and put up a building consisting of 4 independent floors. Mr. X to be allotted 1 floor and 25% of land area. The cost of construction of each floor is 1 crore, which was borne by the builder. The stamp value of the whole land is 5 crores, and in addition, X is paid a monetary consideration of 40 lakhs. You are required to discuss and resolve the following issues. 1. For computation of capital gain, what will be the full value of consideration accruing? Okay, just recollecting whatever we studied is also good in some ways. Okay, question number 12A. In the case of specified agreement, what is a specified agreement? Transfer of land or and building, okay, for joint development. Okay, in case of specified agreement, full value of consideration will be, okay, stamp value of immovable property plus monetary consideration. In the case of specified agreement, which is nothing but joint development agreement, full value of consideration will be stamp value of the immovable property. In this case, okay, construction cost of floor, which I believe is the stamp value always. Okay, 1 crore. 25% of land area. Okay, that is, the land is having, the whole land is 5 crores. He is given 25% of undivided land area. 5 crores into 25%. 5 crores into 25%. Okay, monetary consideration. Monetary consideration 40 lakhs. Okay, therefore full value of consideration, therefore full value of consideration will be 2 crore 65 lakhs. Therefore full value of consideration will be 2 crore 65 lakhs. If X has acquired the property in 3/4 for 74 lakhs, what will be the capital gain? Less ICOA, how much? 74 lakhs into 301 divided by purchased in 2003-4. Purchased in 2003-4, 109. 109. Okay, so 74 lakhs into 301 divided by 109, gross LTCG, okay, is 60 lakh 65,138. This is the answer for the second part. 60 lakh 65,138. 60 lakh 65,138. What are all the various ways by which X can reduce tax planning? For the part C, the answers goes like this. X can invest in another house property. X can invest up to rupees 50 lakhs in 54 EC bonds. In these two ways, he can tax plan it. Okay, I will keep the question 14. I'll come back to question 14. Don't worry. I'll do some extra questions and then come to business exemption. Question number 15. Beta Limited has two units, one engaged in hardware and the other in software. As a restructuring drive, the company has decided to sell the software unit as a going concern for slump sales of 520 lakhs to a new company, Theta Limited, in which it holds 82%. The balance sheet of Beta Limited is as follows. Okay. Share capital, reserves, premium, revaluation reserve, current liabilities, fixed assets, debtors, inventories. The software unit is in existence from 2016. So it's a long-term capital asset. Okay. Fixed asset of the software unit include land which was purchased for 40 lakhs and revalued for 60 lakhs. I will take only original value. The revaluation aspect will be removed. Fixed asset of software unit 140 lakhs. How they say? They say because here it is 200 lakhs, 60 lakhs is land. According to balance sheet 60 lakhs. So remaining 140 lakhs is other assets. Okay. Written down value as per books of account. However, WDV as per IT law is only 90 lakhs. Ascertain the tax liability which would arise from slum sales. What would be your advice for better tax planning? Computation of net worth. Land, original cost, revaluation to be ignored. So I will take only 40 lakhs. I will take only 40 lakhs. Other fixed assets, WDV as per IT law has to be considered 90 lakhs. WDV as per income tax law should only be considered 90 lakhs. Debtors 110 lakhs. Inventories 35 lakhs. All these book values. Less current liabilities. Current liabilities 90 lakhs. worth 1,85,00,000. Computation of capital gains. Computation of capital gains. Full value of consideration. Full value of consideration. It is 520 lakhs. 520 lakhs. This becomes the net consideration also, less cost of acquisition, that is net worth. Benefit of indexation cannot be claimed. So the net worth is 1,85,00,000. Gross Lpcg as the unit is in existence for more than 36 months. As the unit is in existence for more than 36 months. Gross Lpcg as the unit is in existence for more than 36 months. Okay. 3,35,00,000. Computation of tax. Computation of tax. Lpcg taxable at 20%. Lpcg taxable at 20%. And surcharge at the rate of 7%. Company income exceeding 1 crore but not 10 crores. We assume, okay? So 67 lakhs into 7%. And HEC at the rate of 4%. So in the case of JDA, would the resulting property be qualified as investment in? That is a pending thing, Shivaram. I understand your question. That is the new property of 1 crore, whether allotted Geeta Duhal income tax law. One case was there, it is also removed. There is no clarity whether I can claim 54 in that or not. Okay, there is no clarity. So as of now, we are not opening it, and I don't think a question will come. Okay. Tax planning. How to avoid this? That is, as a tax consultant, what will be your advice? Okay. Company already holds 82% of the resulting of the buying company. Okay. If another if another 18% is also purchased before slump sales, then it becomes transferred to a 100% subsidiary company, which is not considered as transfer for capital gains. So the question says already I am holding 82%. If I buy another 18%, the other company becomes my 100% subsidiary. Any transfer by a holding company to its 100% subsidiary company shall not be regarded as transfer, no capital gain. That can be one means, or instead of slump sales, if it is demerger, then too it is not transfer. Okay, so these are all the two tax planning advices at this level you can give. Okay, right? Make it as a 100% subsidiary company, or make the transaction more as demerger. Of course, demerger has some demerits that the book value should only be taken, etc. But make the transaction as demerger so that it will not be regarded as transfer. Question number 16. X Limited, a company in which the entire share capitals was held by Y Limited. Both X Limited and Y Limited are Indian companies. X Limited had made an investment in shares of ABC Limited in 1989 for 3 lakhs, which it sold to Y Limited on April 1st, 2010 for a consideration of 30 lakhs. The fair market value 20 lakhs. Y Limited disinvested 5% of its shares in X Limited in January 2021 by sale to public. It also sold the shares of ABC Limited in March 2021 for a sum of 70 lakhs. Discuss the issue relevant to the provision and tax effect of this transaction dance of X and Y Limited in the relevant assessment year. Read through. Just now I was telling transfer of asset by a holding company to 100% subsidiary company or vice versa will not be treated as transfer provided the transferee company is an Indian company. transfer of asset by a holding company to 100% subsidiary company will not be regarded as transfer provided the transferee end company is an Indian company. Okay, transfer of holding company to subsidiary company or vice versa will not be regarded as transfer provided the receiving entity is also an Indian entity. The relationship, what relationship? Holding 100% subsidiary. Should prevail at the time of transfer. Okay, the relationship should prevail at the time of transfer. Not that I am saying it should be a permanent relationship and all. At the time of transfer, it should prevail. In the given case, shares of ABC Limited, was transferred by X Limited to its 100% subsidiary X Limited companies which you hold which are okay transfer okay. To its 100% holding Y Limited, okay, in April 2010. In April 2010. Hence, the transaction is not transfer and no capital gain for FY 10-11. At that time, when the transfer took place, they had the 100% relationship. It is not a transfer, no capital gain. It is not a transfer, no capital gain. Subsequent, okay, sale of shares of X Limited by Y Limited will not affect the exemption enjoyed. So that exemption subsequently in 2021, Y Limited has disinvested 5%. So X Limited is no more a 100% subsidiary, only 95%. But that will not change the exemption. The exemption you already got is what you got and it is acceptable. Computation of capital gains for transfer of ABC Limited shares by Y Limited. Full value of consideration 70 lakhs. Oh, sorry. It is a transfer. So we need to work out as per law, as per Manjula J. Shah. Because it is a inheritance and transfer or succession. All successions will have this. All successions will have this. this is also the net consideration. Less ICOA. In the case of law, FMV as on 1/4/2001, 20 lakhs into 301 divided by, okay, on April 1st, 2010. So 10/11. So 10/11, 167 year of succession. Okay. Whereas if it is Manjula Desha case, it is 301 divided by 100 base year. Okay. So here it will be 20 lakhs into 301 by 167. Whereas here it will be 20 lakhs into 301 by 100. Gross Ltcg. Okay. The tax effect of this transaction in X Limited, nothing is the tax effect, only for Y Limited. This is exemption based. Okay. Okay. We will complete the rest of the provision and come to these questions. We will complete the rest of the exemptions and come to these provisions. Two business exemptions. Whenever we are talking about business exemptions, you need to understand two things. All of you, please understand. First thing is, except land, all other things will only have short-term capital gain. Except land, all other things will, because others are depreciable asset. Only land will have long-term capital gain, except land. So other than land, everything will have only short-term capital gain. First thing to understand. LTCG is taxable at 20%, STCG at normal rates, which can be 25%, 30%, whatever it is. So always provide exemption first for STCG and then only for LTCG, because LTCG is taxable at a rate higher than, STCG is taxable at a rate higher than LTCG. So exemption should be provided so. So two things before walking into it is, for all business associates, majority of the gain will be short term, except for land. Other than that, all are depreciable asset, short term, and exemption, please provide short term. The first one is very simple. Compulsory acquisition of land and building. I am carrying on my business, metro rail project. My land and building is compulsorily acquired by the government. I buy another land and building to re-establish my business. Claim exemption. Compulsory acquisition of land and building. Purchase new land and building within 3 years of compensation receipt. New asset should not be transferred within 3 years. CGADS is as like 54. Before quantum, it should be understood that the result will be both LTCG and STCG. Gross capital gain or amount invested, whichever is less, where both STCG and LTCG are available. First provide for STCG and balance towards LTCG. In this questionable area is this 54G. In this questionable area, 54GA is not, 54G sometimes they ask. Transfer from an urban area to a non-urban area. I want to develop, the country as a whole want to develop the backward areas. So if you shift your industrial undertaking from an urban area to backward area, so what happened? You need to sell off the assets in the urban area and purchase new asset in that backward area. Purchase of land, building, plant and machinery in the non-urban area. Remember, not for furniture and intangibles. Don't transfer the new asset within 3 years. Same exemption. Even shifting cost you can claim. Even shifting cost you can claim. That became the judgment in a case law. Okay. Fiber board. Can advance be paid for land and building for shifting of industrial qualify? Yes, it is okay. Even if it is before, intention of investment is superior. Okay. In this now it is not a recent case law for you, but remember, even shifting clause cast can be claimed. (54GB), not a very popular section, but I want you to understand it. Okay, it is combo of domestic plus business. Sell residential property, invest in startup. Sell residential property and invest in startup. That is not sufficient. That startup should in turn invest in plant and machinery or technological assets. Okay, remember, available for individuals and HOF. Asset transferred should be a long-term capital asset. Asset transferred should be a long-term capital asset, which should be a house property. Which should be a house property, not jewelry, not shares, not even vacant land. It should be a house property. Assessee should have invested in equity of eligible company. the investment should at least be 25% of the voting power. I know this is not an amendment for your year. It was an amendment on 2019 itself. But in 2019, after that, they did not question. You all know there was only one examination which was happening, etc. So I want you to remember, till the financial year 1819, till the financial year 1819, this was 76%. You should be the major shareholder. Now they reduced it. It is enough if you are 1/4 shareholder. That is, a special resolution cannot be passed without your approval. So, if you are investing in 25%, that is sufficient. Okay. Eligible company is SMEs, nothing but. Investment should be made before due date of filing return. What now comes the important? The investment should be utilized for purchase of plant and machinery, and if there are any unutilized money, keep them deposited in a special account. In case of eligible startup, okay, the company can utilize for purchase of computer hardware and software. Remember, that is the importance here. The importance is not what you are investing in shares. In turn, the company should invest in these things. Quantum of exemption, Lpcg, into amount invested divided by net consideration. So it is like 54F. The numerator is not what is invested in shares. In turn, what the company is investing in the plant and machinery, which is for manufacturing or computer hardware, software, etc. Before going and completing the rest of the question, I am taking up an area of Amendment in Finance Act 2020. Okay? Amendment in Finance Act 2020. For understanding this amendment, if you have already seen the amendment lectures, that is different. If for understanding this amendment, understand how mutual funds now work. How mutual funds work. Mutual funds are allowed by SEBI to split their portfolios into two. That which is dynamic and performing portfolios, that which is not very dynamic. Okay, so we call it as side pocketing or segregating, because the overall value of the company depends on the total portfolio held, but the net asset value comes down because of this non-performing assets or non-performing portfolios. So now they are allowed to segregate their portfolio into two, performing and or dynamic portfolio and side pocketing or non-performing portfolio, so that NAV will be separately known. If you are a unit holder of a mutual fund, you have invested through mutual fund, you also need to now segregate your investment into two. Okay, right, let's go slow. Concept of segregated portfolio. SEBI has introduced the concept of segregated portfolio, by which Mutual funds can bifurcate their main portfolio, okay, bifurcate the main portfolio, those which are performing, and side pocketing or segregating the other portfolios which are not performing. Okay, it is like performing asset, non-performing asset. Okay, a performing asset is a main portfolio, non-performing. Mutual funds are investors that judge mutual funds on net asset value, NAV basis. These segregated portfolios reduces the NAV of the fund as such. By side pocketing methodology, NAV will be separately identified for the main portfolio. What is total portfolio? Entire. Divide it into two, dynamic or main portfolio, side pocketed or segregated portfolio. Total portfolio means total number of investment or portfolio held by the fund. Segregated portfolio means portfolio comprising of debt or money market instrument affected by credit events that has been segregated. Main portfolio is total portfolio minus segregated. Main portfolio can be redeemed by the investors any point of time. Segregated portfolio are allotted in the same ratio in which investor hold the total portfolio, and segregated portfolio are not redeemable. If I have 1,000 and the company is dividing their main portfolio and segregated portfolio in the ratio of 9:1, 1,000 into 1 by 10, 100 units I cannot redeem because it belongs to segregated portfolio. Such segregated portfolio will have a different NAV. Taxation. Holding period shall be for the segregated portfolio. Taxation for the main portfolio, we all know, we compute on when an asset transaction happens. Holding period shall be the original date of acquisition. Cost of acquisition will also be split on a proportionate basis. Please read through. Not yet question. Might be a small theory question, etc. for your November examination. Along with the case laws, the theoretical understanding is over, more than sufficient. Standalone question, more than sufficient. Okay. Question number 14. Soumya purchased a residential house in 2005 for 30 lakhs, sold it on 7th November for 120 lakhs, stamp value 150, paid brokerage of 1%, invested 100 lakhs in the equity shares of Silicon Chips Private Limited, a newly formed technology-based company which qualifies for SME. Soumya holds 29% of the share capital of the company. The company utilized the 1 crore in the following manner. Purchase of electronic, electrical and technological asset 85 lakhs, including 8 lakhs for air conditioners. You will not allow it. Deposit before the due date 15 lakhs. The due date of filing is the, okay. Assume that she files on 28. Compute the capital gain arising from the above transaction. full value of consideration, actual consideration. She sold the house for 120 lakhs. Stamp value 150 lakhs. 150 lakhs. 110% of actual consideration. Since the stamp value exceeds 110% of actual consideration, stamp value will be treated as full value of consideration. Since this value exceeds 110%, stamp value will be taken as full value of consideration. Less cost of transfer. Okay, it says Soumya paid 1% of sale value. It will be only 120 lakhs. In examination tension, don't put it on for 150. 120 is only the sale value. On that only I need to compute. Brokerage will be paid only on the sale value. Less ICOA, indexed cost of acquisition. He purchased it for 30 lakhs in April 2005. 30 lakhs into 301 divided by April 2005 is 56117. 30 lakhs into 301 divided by 117. Gross LTCG is this amount. Less exemption under section 54GB. Gross LPCG into amount invested by the company in eligible assets plus deposit divided by net consideration. Gross LTCG is 71, 62,051 into amount invested. Okay, she invested 1 crore. Okay, amount invested is 85 minus 8 plus 15. Repeating, this 8 lakhs will not qualify. Okay, 85 minus 8, but the deposit made will qualify, plus 15 divided by 1 crore 48 lakh 80,000 net consideration. Okay, so it will be this into 92 lakhs, okay, divided by this. Taxable LTCG. Question number 17. DM Limited, which owns an industrial undertaking in Delhi, decided to shift to itself to a backward area in Haryana. Following assets are held as on 1420, 42, 12 and industrial land acquired in 1991 FMV 3 lakhs in order to establish the new assets. The assets are sold as follows: plant and machinery, building, land. New assets were acquired in Noida, plant and machinery, land and building for which advance has been given 20 lakhs. Additional 5 lakhs needs to be paid. Compute capital gain. Compute capital gains. This is under 54G, shifting of an industrial undertaking from an urban area to a non-urban area. Computation of Lpcg for land. First, let me compute for land separately, because for land it will be Lpcg, for others it will be STCG for depreciable asset. Full value of consideration. Full value of consideration, it is sold for 35 lakhs. It is sold for 35 lakhs. Less ICOA. 3 lakhs is the 142,001 value. 3 lakhs is the 142,001 value. So 3 lakhs into year of transfer divided by base year. Okay, so I am getting a gross LTCG from sale of land, gross LTCG from transfer of land, 25 lakh 97,000. 25 lakh 97. Whenever there is a depreciable or non-depreciable asset, the only non-depreciable asset is land. For land, we should work out separately, because that will give us a gross LTCG, whereas for depreciable asset, it will be STCG. Computation for depreciable assets. Particulars: plant and machinery, building. Opening WDV, 42 lakhs, 12 lakhs. Additions. Don't worry about the date of addition. 15 minus 3. 3 lakh is received as subsidy. Where you receive subsidy, okay, where, according to section 28 and ICDS, if subsidy is received towards a depreciable asset, then such subsidy should be adjusted with cost of asset. So what happens here? I will only record 12 lakhs. Here nothing. The building is not yet put to use. Land and building for which advance only has been given. Okay, advance only has been given, so you cannot. Deletion. Sale value 33 lakhs and 50 lakhs. 33 lakhs, 50 lakhs. balance in block. Here it will be balance in block of 21 lakhs for which depreciation can be claimed. So that is, don't worry about depreciation. We are only working capital gains. Short-term capital gain. Short-term capital gain for building becomes 38 lakhs. If it is short-term, go green. If it is short-term, go green. So 38 lakhs is my short-term capital gain. Short-term capital gain, don't worry about depreciation. Plant and machinery block has not gone, it is still there. So only building, the block is not there because there is no addition, the block is not there, and it has resulted in a short-term capital gain of 38 lakhs. Computation of exemption. Particulars, Lpcg, STCG. On sale of land, I got an Lpcg. I got an Lpcg of 2597. On building, I got an STCG of 38 lakhs. I got an STCG of 38 lakhs. Exemption under section 54G. Exemption under section 54G. I purchased plant and machinery. Plant and machinery purchase, we all know 12 lakhs. Advance paid, just now I read the case law also for you. Advance paid 20 plus additional 5 to be made, 25 lakhs. Okay, so total investment is 37 lakhs. Total investment is 37 lakhs. Give it only for STCG. Give it only for STCG, where both STCG and LTCG are there. The benefit is always provide for STCG because that is the best tax planning mechanism by which you are saving tax. Gross taxable LTCG slash STCG. Gross taxable LTCG is 25 lakh 97,000, whereas STCG it is 1 lakh. Whereas STCG it is 1 lakh. Whenever we have both STCG and LTCG, provide for LTCG. Advance paid, payable, everything is investment. Intention is investment. If investment intention is proved, go ahead and provide the exemption. Question number 18. Ashish Mehta owns acres of land which he has purchased in 84-85 610. A stamp value as on 1/4/2001 945. Ashish converts this property as stock in trade in 1718, recording a value of 55 lakhs, whereas the fair market value is 65 lakhs. Ashish spends 31 lakhs for construction of and 2,45,000 for various approval. He starts to develop the property in March 18. In April 2020, he enters into an agreement to sell two houses for 40 lakhs each and receives 10 lakhs advance for house 1 in cash and house 2 through check. Stamp value on that date 35 lakhs. In Feb 21, he completed the said property into 4 houses and sells them all. The remaining 2 properties were sold for 51 lakhs when the stamp value on that date is 45 lakhs. Out of the sale consideration he received, invest 50 lakhs in NHAI bonds and REC bond. Determine the year of taxability of the conversion and the sale and the amount chargeable to CG and PGBP. Also, rework the solution if the land was initially purchased. No, don't worry about the reworking. That is a very interesting part. Just wait it. Okay, very nicely drafted question. Don't think that I am self-boasting, but overall we'll understand a lot of things. That's what I am saying. Okay, sorry if I not actually. First point, where stock in trade is converted into asset, it is regarded as transfer. Capital gain will be computed only in the year in which where asset is converted into stock in trade is regarded as transfer. Capital gain will computed only in the year in which stock in trade is sold. Okay. However, the numerator will be year of conversion. Whenever you compute the capital gain is different. For computing capital gains, the computation, the numerator, the transfer has already happened. That is when you converted it. Okay, okay. Computation of capital gains. Computation of capital gains. Ashish Mehta acquires land in 85, it is 945, converted into stock in trade 50 lakhs. Okay, full value of consideration, that is fair market value prevailing on the date of conversion. On the date of conversion, fair market value prevailing on the date of conversion 65 lakhs less ICOE less index the cost of acquisition. How much it is? Ashish convert, okay, 9,45,000. 9,45,000 into year of conversion. Okay, Ashish converts it in 2017-18. 2017-18. 272. Okay, 272 year of conversion into stock. Okay, divided by 100 the base year. Repeating, 9,45,000 into 272. Numerator will be year of conversion divided by 100. Gross LTCG taxable only in 2021 as the stock is sold only in that year. Okay, so even though this numerator is so, but I will tax it only in the year in which, sorry, gross LTCG taxable. Okay, exemption under 54 EC. Exemption under 54 EC, you can see that they have invested 50 lakhs in REC bonds, 50 lakhs in NHI. Only 150 lakhs will be provided, and you can see it in the theory also. I have written this point, okay, to be clear. Okay, it has been clarified by law that in case of asset converted into stock in trade and sold 6 months from the date of sale of asset. So asset is sold somewhere in February only. 39, 29, 600 fully. Okay. Taxable LTCG will be nil. Because you have invested 50 lakhs, the taxable LTCG will be nil. Computation of business income by applying 43 CA, where land is held as stock in trade. 43 CA is applicable. Particulars: house 1, house 1, house 2, house 3 and 4, because those two are straightforward computation. Okay, house 1, house 2, house 3 and 4. Actual sale value. Actual sale value. Okay. House in April 2020 entered into an house to sell 2 houses, 40 lakhs each. 40 lakhs each. Stamp value on the date of registration. Stamp value on the date of registration as advance has been received to unapproved modes. Okay, cash and check. You should get it only by account payee check, account payee draft, ECS, NEFT, RTGS, debit card, credit card, any of the government payments. Otherwise, it is an unapproved mode. In this case, for first house it is received in cash, second house it is received in check. So I will not take the stamp on the date of agreement. I will take the stamp value on the date of registration, which is 45 lakhs for each house. 110% of actual sale value okay, since stamp value exceeds 110% of actual sale value, stamp value will be treated as sale value. So what happens? Only 45 lakhs will be treated as sale value. For these two houses, no problem. It is sold for 51 lakhs each. So 51 lakhs into, I hope we are clear. For house 1 and house 2, the biggest problem is you have received the advance through unapproved modes. So my total sale value comes to 45 plus 45 plus 102. This is my total sale value. Less FMV on the date of transfer. What is that? Because up to this you have already taxed, you should not again tax 65 lakhs. Development cost. Okay. Development cost. The question has said spends 31 plus 2.45. Okay. 31 lakhs plus 2,45,000. Okay. So business profit leave the second part. Don't worry about it. Question number 19. Mr. Shivanarayanan invested in a mutual fund for 11 lakhs on 1st January 18 when the NAV was 100 crores. On 1st May 20, when the NAV was 180 crores, segregation of portfolio was credited due to a credit event or created due to a credit event. Post creation, main portfolio 150, segregated portfolio 30. In March 2021, Shivnarayanan redeemed the main portfolio for 12 lakhs, specified the tax impact. Okay. In case of segregation or side pocketing by the mutual fund, the investor or the unit holder, however you call him, shall also split the investment as main and segregated. Total investment by Shivnarayan. Total investment by Shivnarayanan 11 lakhs. Split undertaken by mutual fund. What ratio? NAV was on the segregation. Post creation 150 is to 30. 150 is to 30. Okay. Hence, COA of main portfolio for Shivnarayanan will be 11 lakhs divided by 180 into 150. 11 lakhs, okay, 11 lakhs into, okay, 150 divided by 180. Okay, this is for main portfolio. Okay, redemption value is 12 lakhs. Therefore, capital gains on main portfolio. Therefore, capital gains on main portfolio will be 2,83,333. Therefore, capital gains on main portfolio will be 2,83,333. Segregated portfolio will have a COA, cost of acquisition, of 11 lakh divided by 180 into 30. Okay, 11 lakh divided by 180 into 30. Okay, the original, the cost, I mean, the date of acquisition will continue to be whatever it is, and 2018. Whenever these segregated portfolios are redeemed, capital gain will be computed. As of now, you cannot redeem it. Segregated portfolios cannot be redeemed. There is no NAV for that. So, capital gain will be computed whenever it is redeemed. Tanya inherited her grandfather property in July 2005. Grandfather has acquired for 6 lakhs. Fair market value is 51 lakhs, whereas stamp value 49. 49 only should be taken. Danya sold the property during the previous year for 3 crore. Incurred is 12% stamp duty allowed. Danya invested in 2 house properties, 54. Okay, compute the CG. I leave this question to you. The answer will be there in the solution material. Basically, I brought this question for this amendment, that your fair market value should not exceed the stamp value. So stamp value should only be taken. We have already worked sufficient questions on that. So let us not waste time. Okay, right? So that brings us to the end of capital gains. This can be a standalone questionable chapter. It can be on the basis of case laws or simple questions only. 54 is being tested very often, or slum sales is being tested very often. Okay, it will be a simple question, but slum sales rare is my opinion, because next year the law changes to a little extent. For slum sales and dissolution, the law has completely changed. So please give a good reading of capital gains. That is, these 20 questions should be more than sufficient for you to understand the whole of that chapter. Before going into the next arena, I have a question from our friend. I will try to answer that. How do we know that the company is only investing in technology? The honest person has to certify it. That is the only answer I can as of now give. Yeah, it's a certificate based that they are given in the law. They are given what is technology assets. Do not worry, from the examination perspective, they will very specifically give you that it is a technology based asset. Well, two of the grandeur chapters are over, that is PGBP and capital gains. Salaries and house property. House property, then and there we are covering. If you look at our non-resident taxation, we did lot of house properties wherever, even in profit and gain, some RST limited, we did arrears of rent, land revenue, etc. So wherever possible, we are doing house property. Salaries along with assessment of individuals, we will cover. IFOS, a quick look at our IFOS, because sometimes this gift becomes a taxable question also. So just a quick browse through of IFOS. Any income, any receipt which is treated as income. All receipts are not income. Loan is a receipt but not an income. Share capital is a receipt but not income. Any receipt which is treated as income, which is not taxable under the other four heads: salaries, house property, PGBP, capital gains, which is not taxable under the other four heads and which is not specifically exempt, is taxable in IFOS. Once more, any receipt which is treated as income, it should be a receipt, it should be an income, which is not specifically exempt, which is not taxable under the other four heads, it is taxable under IFOS. From the examination perspective, this is the most important thing to understand, that is gift. From the examination perspective, the important thing to understand is gift. What is gift? Which comes relatively free of cost to me. Both monetary and non-monetary gift. Non-monetary is further split into movable and immovable. And immovable only consists of jewelry, shares, securities, paintings, sculptures, etc. So same as capital gains. Same as capital gains. So if you give a car, it is not taxable. If you gift a car, it is not taxable. It is not a specified movable property. If you gift a keyboard, if you gift a laptop, these are not taxable because they are what are all taxable? Monetary, immovable, land, building, both, movable, jewelry, shares, work of art, architecture, painting, foreign currencies like bullion, etc. are only taxable, and the following gifts are not taxable. Gift from any relative is not taxable. Gift on the occasion of wedding is not taxable. Gift by way of inheritance due to the death of a person through will is inheriting, not taxable. Gift from a public charitable trust, more like subsidy, etc., are not taxable. Repeating, gift from relatives, gift on the occasion of the wedding of the assessee, gift on the occasion of wedding of children of the assessee, taxable. Gift on the occasion of wedding of brother of the assessee, taxable. If it is assessee's wedding, then the gift received is not taxable. Gift through inheritance or will that is due to the death of a taxpayer. Okay. Gift from public charitable institutions, other things are not taxable. Are not taxable. That leads us to the explanation of what is relative. Spouse, brothers and sisters of spouse, their respective spouse. Parents, parents of spouse. Lineal ascendants, descendants. Okay. For a Hindu divided family, any family member and a wholly owned subsidiary company giving to its holding company is also not taxable. Read through. This is important to understand. Gift from relatives, not taxable in IFOS, not taxable under capital gains at the time of gift, as it is not transfer. We all understand that. When the receiver subsequently sells it, taxable. COA is cost to previous owner. Gift from relatives, not taxable in IFOS. Gift from relatives are exempt. Not taxable for the donor in capital gain also. Gift is not a transfer, so not taxable. For the receiver of the gift, when he subsequently sells it, it is taxable. Cost of the previous owner will be considered as his cost of acquisition. Cost of acquisition will be cost to the previous owner. Gift from non-relatives, taxable under IFOS. This is a consequential thing you have to understand. Taxable under IFOS. Okay, under section 56, this becomes taxable. Not taxable for donor, as gift is not transferred. Okay, and this is the amendment you have to understand. Subsequently, when the receiver sells, taxable COA will be fair market value on the date of gift. Okay, on the date of gift, fair market value or stamp value. Fair market value in the case of movable and stamp value immovable on the date of gift. This is something very important to understand. Consequential amendment. Now you cannot take, I have already paid tax here. I have already paid tax. Again, don't ask me to pay the tax taking the cost of the previous owner. I have already paid a tax at the time of receiving the gift from a non-relative. I have already paid the tax. Okay, so whatever is the income I have considered will become the cost of acquisition. The income will be stamp value or fair market value. That's what we are going to study. I'll work out a solution also and show you. Okay, now taxability of gift. Monetary gift, if the aggregate value, aggregate means all non-relatives put together, if it exceeds 50,000, whole of the value is taxable. all non-relatives put together if the whole of the value exceeds 50,000. Immovable property without any consideration, you should take the stamp value, and that stamp value exceeds 50,000, it will become taxable. Inadequate consideration, we have already seen these provisions in capital gains. I explained you. Okay, we did a question also, Vallish, Ravi, Hari. Okay, all these things. Inadequate consideration means difference between stamp value and consideration paid. Difference between stamp value and consideration paid. If the inadequate consideration does not exceed 50,000, leave it. If the inadequate consideration exceeds 50,000, but the difference is only to the extent of 10,000 or 10% also, then it is not taxable. 10% here and there, it is acceptable. Okay. If the inadequate consideration exceeds 50,000 and also exceeds 10%, the entire amount of inadequate consideration is taxable. This is the amendment. The 10% is the amendment. That's why it's in blue. It might exceed 50,000, but the difference is only 10%. Ignore. If the difference is more than 10% but does not exceed 50,000, ignore. If the difference is more than 10% and also more than 50,000, then the entire inadequate consideration taxable. Movable property, fair market value will be taken. So, if it exceeds 50,000, whole amount. Inadequate consideration, difference between fair market value and consideration. Less than 50,000, ignore it. More than 50,000, entire inadequate consideration becomes taxable. And what date of stamp value? Yesterday we studied this concept, so we are clear with it. Quick read through. Okay, we studied this recently only. Okay, when we do question, we will become more clear in this. Okay, if there's some fancy area of questioning, let's keep moving and we'll go. When we do questions, we will see other incomes and their respective deductions in IFOS. This is an amendment only because this is the year in which we have removed the entire 115O. Dividend income, all dividends are taxable here in the hands of the receiver. Only interest on loan borrowed for investment is allowed. Please remember, against the dividend income, you can only claim interest on loan borrowed, that too to the extent of 20% of dividend received. That too only to the extent of 20% of dividend received, not more. Only interest on loan borrowed for investment, maximum shall be 20%. Winnings are taxable at 30%, no deduction. Interest, all types of interest are taxable. All types of interest are taxable here. collection charges and interest on loan taken for investment, you can claim it as deduction. Composite rent, letting out of building, plant, machinery, etc. Okay, without splitting, they are letting it out. All direct expenses, including depreciation, can be claimed. Shares issued by a closely held company. Shares issued by a unlisted company. Difference between issue price and fair market value is treated as income. My fair market value is coming to 40 rupees. I'm issuing for 100 rupees. When it is there for 40 rupees, who will buy for 100 rupees? So 60 rupees is the income into number of shares issued and no deduction will be allowed. Yesterday I was just giving you a brief. Interest on delayed payment of compensation, taxable only in the year in which compensation is received. 50% of such compensation is treated as expenditure. Blanket deduction of 50%. Advance money forfeited, fully treated as income. That is, I propose to sell the property and receive advance. The transaction did not go through, I am not repaying the advance. Advance money forfeited is an income, no deduction. Family pension, 1/3 of the pension or 15,000, whichever is less. 1/3 of the pension or 15,000, whichever is less, is allowed as deduction. Agricultural income from outside India. We saw it even in Vivita question in 33 AB. When we are working out plantation sector. From Colombo, we will not split it even 40-60. 100% taxable, no deduction. Rent for subletting, the main property rent can be claimed. Any other income, any direct expenses. More than sufficient this table is. Except gift, I don't find any big question. Only other concept which you need to understand. Only other concept which you need to understand is deemed dividend. Deemed dividend. Okay, a quick look at deemed dividend. Majority of the private limited companies were trying to do this. If they pay salaries, it is taxable in the hands of the director, shareholder director. If they pay dividend, the company has to pay tax and then only pay the dividend, and that is either taxable in the hands of the director or previously the company was paying 150 more. So what they did is they gave loan. Just now I told you, any receipt which takes the character of income. Loan is not an income. So they gave loan to the director. The director never repaid that loan. So it was not at all getting taxed. So came a concept called deemed dividend. Listen, any loan or advance in the nature of loan, provided by a closely held company in which public are not substantially interested, which means unlisted company, private limited company and unlisted public limited. Any loan or advance which is in the nature of loan provided by a closely held company to a substantial interest holder. This is the only place the definition is 10%. All other places substantial interest holder means 20%. This is the only place substantial interest holder means 10%. Any loan or advance provided by a unlisted company to a substantial interest holder or to relative of substantial interest holder or to a company or firm in which such substantial interest holder is a partner, director, etc., will be treated as dividend in the hands of the substantial interest holder. Will be treated as dividend in the hands of the substantial interest holder. Okay, deemed dividend. Okay, 222E. Okay, 222E. Okay, 222E. Who is giving loan? Who is giving? Okay, closely held company, or you can understand it, company in which public or not substantially interested. Who is receiving? Directly by substantial interest holder holding 10%, or indirectly, that is company, firm, relatives of substantial interest holder. To whom it is taxable? To the substantial interest holder, even though it is received by company. Okay, any loan or advance given by a closely held company in which public or not substantially interested to a substantial interest holder or to a firm in which such substantial interest holder is a partner, director in a company in which he is also holding substantial interest, or to his relative, shall be taxable in the hands of the substantial interest holder as deemed dividend. Two exceptions. If the company does not have profit, the company has only loss, dividend can be paid only out of profits. If the company has loss, or if the company is in the business of lending and it has lent in the normal course. Okay, this section specifies the following types. Okay, any disturb. Okay, all these things. In this, the most important is deemed dividend. Okay, in dividend, any loan or advance given by a company in which public or not substantial interest holder to directly a person who is having substantial interest, or to HUF, firm, AOP, BOI in which such shareholder holds 10%, or any relative, shall be deemed to be dividend. However, in the following cases, it will not be taxable, where the company has only losses and not income, where lending is the substantial part of the business. What is substantial part? More than 50% of it, of the income should be from lending. Appada, it is known as substantial part. Section 8 of the Act specifies that deemed dividend shall be taxable in the previous year in which it is. For a lottery dealer, is the winnings taxable as business income or IFOS? IFOS only. Lottery dealer winning prize money on unsold lottery tickets. Nature of winning is different from income received. The income received is not commission, hence it is taxable under IFOS only. Value of the property. Compulsory acquisition was originally determined by the local authority and was subsequently enhanced. Along with the enhanced value, interest was paid for wrong determination of value. Why did they pay interest? Is it for enhancing the compensation or delay in payment of compensation? No. Interest was paid for wrong determination of value. Okay, this is the reason they paid the interest. The question in front of law, whether the income is taxable under IFOS or capital gain. It is taxable under capital gain and not held by the court that such interest is not for delayed payment of compensation. Then only it is taxable in IFOS, otherwise capital gains. Read through the chapter. Shall we start? Quick answering of IFOS. Ayushman Private Limited has only 3 shareholders: Sharada 1 lakh shares, Anu 1 lakh shares, Ranjini 50,000 shares. Shares are on the face value of 10. The company declared a dividend of 40% for the financial year ending 31st March, which were received by the shareholders in September. All the 3 of them have taken loan for the purpose of investing. Sharada is liable to pay an interest of 1 lakh, sorry, that 0 is missing, 1 lakh, Anu 75,000, Ranjini 50,000. This apart, in the previous year, Sharada and Anu took loan from the company of for 20 lakhs each. Sharada was able to repay it before the year end, whereas Anu is unable to repay. However, Anu agreed to pay interest of 12% of such loan. The other sources of income which are taxable at normal rates are 20, 43 and 50 lakhs respectively. Compute taxable dividend and tax due thereon. Read through. Dividend received. So she is holding 1 lakh shares. 1 lakh into 10, 10 lakhs into 40% is the dividend. Dividend is always on the face value. We know 1 lakh into 10 into 40%. Same for Anu. Ranjini is holding 50,000 shares. Yes. Interest on borrowings, actual interest, or 20% of dividend, whichever is less. Actual or 20% of dividend. Only interest on borrowings is allowed. All the three of them have taken loan for Sharada is liable to pay interest of 1 lakh. Minimum of 1 lakh, or okay, this into 20%, whichever it is applicable. Minimum of 1 lakh or 20% of dividend, whichever is. Okay, for Anu it is 75,000. Okay, for Ranjini again, minimum of this into uh, minimum of what is the actual pay? 50,000. Okay, or 2 lakhs into 20%. Okay, so 40,000. So 80, 75. Okay, maximum actual interest or 20 per whichever is less is only allowed. Okay, taxable normal dividend. Taxable normal dividend is 4 lakh. Okay, minus for Sharada 320, for Anu 325, and for Ranjini 160. Deemed dividend taxable under 2 subsection 22 clause E. Okay, clause E. Okay, please remember. Okay, this is taxable even if the loan is repaid or interest is paid. Okay, this is clearly taxable. You are not supposed to get loan. So Sharada and Anu took 20 lakhs each. Even though they repaid, it is taxable. Then everybody will repay on 31st March and get back again on 1st April. Even if you pay interest, it is taxable. Interest will not be allowed as deduction. Interest will not be allowed as deduction. Other income 20, 43, 50. 20 lakhs, 43 lakhs, 50 lakhs. 20, 43, 50. Total income 43 lakh 20,000, 66 lakh 25,000, 51 lakh 60,000, 43 20, 66 25, and 51 60. Okay, computation of tax. Base tax, very simple. Whatever is the income minus 10 lakhs into 30% plus 1,12,500. Okay, okay, right. So 33 lakh 20,000 into 30%. 33 lakh 20,000 into 30% plus 1,12,500. 56 lakh 25,000 into 30% plus 1 lakh, like that. Okay, and surcharge at the rate of 10% if income exceeds rupees 50 lakhs. If income exceeds, so for Sharada it will not come, for Anu and for Ranjini this will come, and HEC at the rate of 4%. Arun, a dealer in shares, received the following as gift during the previous year from his friend Praveen. Cash gift, bullion, the fair market value being 60,000, plot of land in Faridabad, the stamp value which is 5 lakhs on the date. Praveen had purchased it in 2009. Apart from the above transaction with Praveen, Arun also purchased from his friend Aishwarya, who is another stockbroker, 1000 shares of X Limited at 400 on 19th June when the fair market value was 600. For income of 5160, why are we not computing marginal relief? Income exceeding 50 lakhs is 1,60,000, whereas surcharge is only 1,36,000. Only marginal relief is a concept where if this is 1,36,000 and this is 1,60,000. Are you understanding? Marginal relief, when I will compute? I will compute and show in assessment of individual. When I need to compute is income exceeding 50 lakhs, if the surcharge is more than income exceeding 50 lakhs. Income is 51 lakhs. For example, I will just adjust and show you. 51 lakhs. Now you see, my income exceeding is 1 lakh, whereas surcharge is 134,250. I need to compute marginal relief. Here, income exceeding is 160, surcharge is only 136,050, marginal relief will not come. Coming back to the question. Apart from the above mentioned transaction with Praveen, Arun also purchased from his friend Aishwarya 1000 shares of 400 each when the fair market value was 600. Arun sold these shares for 650. On 1st November 2020, Arun took possession of a building booked by him 2 years back at 20 lakhs. The stamp value on this date is 32 lakhs and on the date of booking is 23 lakhs. Arun paid 1 lakh by account payee check as advance at the time of booking. On 1st March 2021, Arun sold the Faridabad land for rupees 7 lakhs. Arun sold the Faridabad land for rupees 7 lakhs. This is what I am saying is that this is the land which he has got it as gift and sold. Compute the income of Arun chargeable under various heads. Please read through. First, I will do a working note for gift so that that part of it was over, and then we will go to total income. Gift from Praveen is a non-relative. Okay, cash gift 75,000 exceeds 50,000 taxable. Bullion taxable. Stamp value of land in Faridabad taxable 5 lakhs. Purchase of shares from Aishwarya not considered as gift. Why? Arun, the assessee, is a share dealer, so what is received is stock in trade. What is received is stock in trade. Remember, the question starts here. Mr. Arun, dealer in shares. So, whatever he got from Aishwarya is nothing but stock in trade. It will not be treated as capital gains. It will not be treated as IFOS gift because what he received is in stock in trade. Inadequate consideration of land purchased. Actual consideration paid. Actual consideration paid 20 lakhs. Stamp value on the date of agreement, nothing but booking, as advance is paid through approved modes. Since you have paid advance, that too through approved modes, okay, on the date of booking, your stamp value is 23 lakhs. Okay, 110% of actual consideration is 20 lakhs into 110%. Stamp value exceeds 110%. Inadequate consideration. What is inadequate consideration? Difference between stamp value and consideration paid. Also exceeds rupees 50,000. Whole of the inadequate consideration, becomes taxable. Okay, so 23 lakhs minus this 20 lakhs, 3 lakhs becomes taxable. Look through. So inadequate consideration, if it exceeds both the 10% and such inadequate consideration exceeds 50,000, the whole of inadequate consideration. Inadequate consideration means difference between stamp value and actual consideration. The whole of inadequate consideration becomes taxable. Sale value of shares. Okay, he received 1,000 shares from Aishwarya and he has sold the shares at 650. Okay, 1,000 shares, okay, into 650. 1,000 shares into 650. Less cost. 1,000 shares into what price he paid for the shares? 400. So anyhow it becomes taxable. Don't worry that even if you have not taxed the inadequate consideration part, you will tax it under PGBP. Capital gains. Land in Faridabad, which is received as gift, now transferred. How much is the value of the land? 7 lakhs. Here is what I want you to understand. Less COA, less cost of acquisition, gift from non-relative. Hence, the value of gift already considered will become COA and the date of gift will become date of acquisition. So, I have already taxed 5 lakh. Don't again tax that same money. I have taxed 5 lakhs considering it as gift. Now, if you take the cost of the previous owner as 90,000, is it fair? No. The up to 5 lakhs, I have already paid tax. I have considered it as gift and I have paying tax for that. So, over and above 5 lakhs is only my gain. Okay. Therefore, STCG, therefore, STCG is 7 lakhs minus 5 lakhs, 2 lakhs. 7 lakhs minus 5 lakh, 2 lakh, STCG. Let's go green. IFOS, gift as computed. We have already computed the taxable gift 9,35,000. So total income 1385. question we did it in the capital gains chapter. Harihara Prasad, a property dealer, sold a building in the course of his business to his friend Mr. Ashok, automobile dealer, for 90 lakhs on 1st January when the stamp duty was 150 lakh. The agreement was entered on 1st September when the stamp duty was 140 lakhs. Hari had paid a down payment of 15 lakhs by crossed check on the date of agreement. Specify the tax impact in the hands of both Hari and Ashok, assuming that he has originally purchased it for 75 lakhs. This is the same Hari, Ravi, etc. Okay, so let me go to the solutions material without wasting time. Let us understand this from the solutions material. Okay. Here is the answer. Please understand, here is the answer. If Hari is a property dealer, we all know section 43 CA will be the guiding provision. 43 CA will be the guiding provision. Actual consideration 90. Stamp value on the date of registration as advance is received through unapproved modes. As advance is received through unapproved modes, 150 lakhs. 110% of actual sales, 99 lakhs. Since the stamp value exceeds 110%, stamp value will be taken and 75 lakhs. So his business profit will be 75 lakhs if he is a property dealer. If he is not a property dealer, taxable under capital gains, full value of consideration, that is this 150. Assessee can claim the benefit of indexation if it is held by for more than 24 months. We have not been given. For Ashok, how does this provision work? Actual consideration, stamp value on the date of registration as advance is paid by unapproved modes. Okay, the difference between 150 and 90. This 6, okay. Ashok is liable to deduct tax under, okay. Since stamp value exceeds 110%, inadequate consideration will be 60 lakhs, 150 minus it, and he is also liable to deduct tax. That is the overall answer. We worked a similar question, so I'm saving time. Question number 4. Rupali, again, I'm going to refer only to the answer because not a very great importance. Just we'll go through. Rupali furnishes the following. Net agricultural income from India is exempt from tax. Okay, net agricultural. Net agricultural income, okay, is exempt from tax, but you will use it for step 1, step 2, the tax aggregation. Okay, net agricultural income not taxable. Okay, right. Next, net agricultural income from Sri Lanka 3,10,000. Net agricultural income from outside India 3,10,000 fully taxable. 3,10,000 fully taxable. Profit on sale of agricultural land in Nepal depends upon whether the assessee is a RNOR, NR or ROR. Assuming ROR, it becomes fully taxable. Assuming Profit are not taxable under, but it is taxable under capital gains since assessee is ROR. Okay, not taxable under IFOS. First, I am working IFOS. Computation of taxable income from IFOS is the question. This is not taxable under IFOS. This is only taxable under capital gains. Vacant land. 12,000 into 12, 1,44,000 received. Okay, whatever you received from sale of, ground rent from vacant land is fully taxable. 12,000 into 12, 1,44,000. Rent received for subletting, rent paid for it. So the net aspect will be considered as income. The net aspect will be considered as income. Rent from subletting minus rent paid to the owner. Okay. Maintenance and expenses on let out property you will not allow. Okay, directly. Director's sitting fees 3,600. Director's sitting fees 3,600 fully taxable. We all know 194J is applicable right from rupee 1 for these things. Interest on deposit with nationalized bank, with post office savings bank. Both are taxable, but 80 TTA can be claimed. For the savings bank interest, 80 TTA can be claimed. 80 TTA can be claimed up to 10,000 rupees. 10,000 rupees. PPF interest is never taxable. That's why people deposit in PPF. They get lot of tax benefit. 80C is there, plus interest is not taxable. NSC and post office monthly insurance, monthly schemes are taxable. NSC will always be on eligible accrual basis. So all types of interest are taxable. All types of interest are taxable. Dividend received from Indian companies, entire 1122 taxable, but while main working, I made a mistake. Okay, I reduced the collection charges. Then only I get to see the, okay, please understand, collection charges cannot be claimed. Entire 1122 should be taxable. I made a mistake. Okay, entire 1122 should be taxable. Okay, because collection charges cannot be claimed. Only interest on investment can be claimed. Only interest on investment can be claimed. Okay, I will correct the answer. This is not to be claimed. Dividend from foreign company and interest is allowed as a deduction. Okay, it is not exceeding 20. So it is taxable. Dividend from foreign companies. Okay, okay. Gift from a foreign charitable association not taxable. Gift from a friend taxable. Gift from another friend in Indian currency not taxable, because this has not exceeded 50,000. Only this has exceeded. Winnings from lottery, the gross amount becomes taxable. You cannot claim any expenses. The question itself is total income from IFOS. It will increase by 1100, 1100 it will be increasing. Please check the answer once. If you please write and keep or mark a note that I made a mistake, that dividend, this should not have been claimed by me. This is not to be claimed. During free time, I will try to work out in the Excel sheet itself and give you the answer also. So IFOS, in our final, it is only gift, the main thing. Since dividend becomes taxable now, both normal dividend and deemed dividend, there is a possibility of a question. Otherwise, IFOS is more to do with gift in our question papers. Is more to do with gift in our question papers. Okay, okay, right. With this, I go to some of the chapter 6 deductions. Some of the chapter 6 deductions which are only for business associates. Some of the chapter 6 deduction, because these are essential to go to assessment of firm, assessment of company. These are essential for the purpose of progressing to assessment of firm and assessment of companies. So, I am trying to make you understand some of the business oriented deductions, some of the business oriented deductions in chapter 6A. Let me give you a small idea about these things because I want you to understand why this importance has reduced. We call them as sunset provisions. Shall I repeat? We call them as sunset provisions, which means these are going to go off. 10 years out of the first 20 years you can claim. If you have started before 2015, 2012, 2010. So we are the fag end of the period. We are the fag end of the period. So we call it that in another 3-4 years, these sections will not be there except ATIA for which is still dynamic. Other things will not be there in the law. We call them as sunset provisions. They are going to fade. They are going to go off. That's why the examiners doesn't give much importance to this at all. The examiners doesn't give much importance to this at all. And I have told you there are 3 provisions which are interlinked. 35 AD, 10 AA, 80 I. Repeating, 35 AD, that is for specified business. 10 AA is an exemption, okay, and 80 I. An assessee opting for availing benefit under 35 AD cannot claim here, vice versa. If you are opting for 80 I, you cannot claim 35 AD or section 10. So that is one other thing. And the most important thing in business oriented deduction is all these deductions can be claimed only if the assessee files his income tax return on or before the due date of filing returns. Before 31st October, before 30th November, if you file only, you will get it. Remember, if TP adjustments are made by the assessing officer also, you cannot get this. Any deductions or exemptions cannot be claimed where the assessing officer increases the income of the assessor. What section? What is the deduction? Very simple. what section, what is the deduction. You have to remember this only. That too, I don't know when it was last questioned. They themselves will give you 80 IB, you can claim so much. So, the importance from the examination angle is also fading because these sections are going to go off, this API based. Other things, whatever we discuss, might be important. ATIA, infrastructure oriented deductions are in ATIA. Infrastructure. What is infrastructure? Roads, bridges, railway, telecommunication, electricity, power are all infrastructure. Once more, infrastructure oriented deductions. What is infrastructure? What type of infrastructure facility? Developing, operating, maintaining any infrastructure facility, you can see up to 1417. So already 5 years is over before you write your examination. Our undertaking, generation and setup between these dates, and it will also include renovation and modernization. A power plant, we know a lot of power plants. Now the present government is taking up and saying that we will renovate and modernize the power plant. This is also reconstruction and revival of a power plant, power generating plant. Quantum, 100% for 10 consecutive years. 5 years over. Okay. Sunset provision. Okay. Roads and bridges, 10 years out of the first 20. For power segment and all, 10 out of the first 15. So, whatever is the infrastructure, roads, railways, bridges, telecommunication, power sector, in that power sector only to a larger extent still it is dynamic. Okay, other things completely fading. And these are brought around in 35 AD. I will claim the capital expenditure itself. ATIAB, development of a special economic zone, not for a unit in special economic zone. A person who is developing tidal park, a person who is developing MEPS, a person who is developing Gurgaon, a person who is developing the Hyderabad electronic city, development of special economic zone. 10% for 10 years, 100% profits, and you can see you should have commenced before 31/3/2017. Remember, they get the benefit for all type of passive income also. Development of special economic zone, they will get royalty, they will get rent, sometimes parking charges because they have developed. All incomes they get is getting the benefit of this exemption. Eligible startups, ATIAC, eligible startups. This eligible startup is we are keeping on seeing this eligible startup everywhere. Very soon when we do the salaries and all, ESOP, eligible startup. Now we saw this 54 GB, eligible startup. Business carried on by a eligible startup engaged in innovation, development or improvement of products on a scalable business model. Not only that, with employment generation. So there is something known as interministerial board. They will evaluate the project and say you are an eligible startup. Once more shall I say, interministerial board will evaluate and say you are an eligible startup. Okay, you should have commenced that. This alone is continuing. 100% of the profits for 3 years only. 100% of the profits for 3 years only. 3 years only. Shall we quickly look into 80I consists of 3 sections: 80IA, 80IAB, 80IAC. 80IA, all types of infrastructure, roads, railways, telecommunication, power sector. In that, roads alone 10 out of 20 years, others are 10 out of 15 years, 100% of profits. 80IAB, development of a special economic zone. You should develop a SEZ. Whatever is your direct and indirect income, passive income also is eligible for 100% of profits 10 years out of the first 15 years. You can choose. So if the first few years are lost, you will not choose it. Later you will choose it. 80IAC, eligible startups. 80IAC, eligible startup which is certified by interministerial board. Interministerial board, okay. It can be a company or LLP, and 100% of the profits for only 3 years out of the first 10 years you can claim. 80IA has 3. 80IB, except housing sector, nothing is going to be useful at all. You will see. Deduction for specific business. First one is SSI in Jammu and Kashmir, started before 31/3/2012, last year. % of profits for first 5 years and 25 or 30%. Companies means 30% for the next 5 years. You are in the last year of claiming it. Or next year is the last year. So, fading. Similarly, commercial production of mineral oil, 7 consecutive years, fading. Processing, preservation of fruits and vegetables, meats, all these things 2012, 100% for first 5 years, and so 80IB, forget it. Forget it, it's over, faded. Almost the last ray is going to go inside. Whereas 80IBA is our Prime Minister's dream of affordable housings. So that project, if it is an affordable housing project which has started, whatever you earn in that project, 100% of the profit of that project is given as deduction. Okay, 100% of the profit of the project is given as deduction. Then comes the Northeastern States. So 80IB has 2 things. 80IB main section, which has 3 aspects: Jammu and Kashmir SSI, mineral oil commercial production, and the preservation of. All these are now there in a 35 AD. Why should I come here? There I am getting the full amount as deduction. Cold chain facility, warehousing of agricultural produce, developing of housing, also there in 35 AD. Okay. Because here only if profit comes, I can take the deduction. There I can take the entire capital expenditure as deduction. Further, the loss can be carried forward over indefinitely. 80 IC and IE talks about Northeastern States. This is about Himachal Pradesh and Uttaranchal. Again, you can see, so we are in the last year, 100% first 5 years, balance 5 years, 25 or 30%. Only for manufacture or production. Or sometimes substantial expansion. This is also there in everywhere. Substantial expansion means spending huge money on expanding the project. I'll come to a case law on that. 80 IE is for northeastern states like Arunachal Pradesh, Assam, Manipur, etc., which is where the manufacturing activity is very less. 100% of the profits for 10 years. Area specific question doesn't come in CA examination. This is more area specific. In a national examination, people don't ask. So 80I, can I sum up it? 80IA has three things to be remembered. Has infrastructure facilities, first 80IA, except roads, which is 10 out of 20, all other things are 10 out of 50. Then we also saw in 80IA development of a SEZ, passive income also exempt, deduction alone. 80IAC eligible startup, 3 out of 10 years, 100% of profits. It should be approved by interministerial board. IB consists of three things: SSI of Jammu and Kashmir, mineral oil commercial production, preservation. 100% for first 5 years, 25% if it is non-company, 30%, whereas in the case of mineral oil, only 7 years, 100%. IBA, housing projects, 100% of the profits of that project, wherever you are getting the approval, eligible project. IC, Himachal Pradesh and Uttaranchal, manufacture. IE, other northeastern states, manufacture or production, 100% of profits. Remember this broadly, memory based, I know. Other 80 deductions which are important. These are important. 80 AJAA, deduction for new employees. Deduction for new employees, not just for company, all business associates who are coming under tax audit slabs. All business associates who are coming under tax audit slab can claim. What they can claim? 30% of additional employee cost. 30% of additional employee. What is meant by additional employees? The number of employees as on 31/3/21 should be more than the number of employees as on 31/3/20. First condition. The number of employees as on 31/3/21 should be more than the number of employees as on 31/3/20. What is that? Sir, as on 31/3/20, I had 100 employees. 10 of them resigned, 9 of them newly joined. 9 additional employees. No. Your total count is 99. 100 minus 10 plus 9. I am giving this deduction only if you generate employment opportunity. Only if you generate employment opportunity. Where there is no increase in the number of employees from the total number of employees of the last year, deduction shall be nil. Your number of employees should be more. In that case, I am ready to give. And who is a qualifying employee? The law goes by elimination. Who is not included? The law goes by elimination. Who is not included? One whose salary is more than 25,000 per month. One whose salary is more than 25,000 per month. One who has worked less than 240 days. And one who is not participating in RPF. Shall I repeat? Who is not qualifying? Or who qualifies? Whose salary is less than 25,000, who is covered under RPF, and who has worked for more than 240 days. Seasonal industry, 180 days. Seasonal industry, 150 days. Sorry. Seasonal industry, they will give you seasonal, don't worry. 150. And the salary should not be paid by unapproved modes. The salary should not be paid by unapproved modes. One big benefit the law gives is, if this is the first year, all the employees will be treated as new employees if other conditions are satisfied. Read through. Total number of employees should be more. Salary should be less than 25,000. More than 240 days working. RPF covered. Don't pay the salary by unapproved modes. Get 30%. Okay. I don't know why I didn't put it in blue. This is an amendment. Allowed for domestic companies, ATM, you receive dividend, you give dividend. Allowed if the GTA of the domestic company includes dividend, quantum of deduction, actual dividend received from the above entities, or dividend distributed before 30th September. Before 30th September, whichever is less. Actual dividend or dividend distributed before 30th September, whichever is less. Okay, just read it. I mean, water and come. Yes. Some of the case laws. because if at all there is a possibility, it is only from case laws in this. Okay, I know I have pasted it little later. Page 276 has the case laws. Page 276 has the case laws. Container Corporation of India. You know what they are doing, right? Cargoes, etc. Are they an infrastructure facility? Can they claim ATIA? The company's main activity is handling and transportation of container cargo. They claimed a deduction under ATIA, which assessing officer denied. Held by Supreme Court. Container depot functions between as the benefit of exporters and the importers. The depot act as facilitators and reduces the inconvenience in import and export. Hence, the deduction should be provided. Hence, the deduction should be provided. Very old case law. At that time, these businesses might be covered under ATIA. Very old. Okay. You can see if Supreme Court is the judgment provider, Commissioner Appeals, ITAT, High Court, then only Supreme Court. So, how many years would have lapsed? Okay, you can understand. Ranji Projects Private. Assessee entered into an agreement with Gujarat Road Transport Corporation for infrastructure development project and claimed a deduction. However, the assessing officer contended that for a deduction, agreement should have been entered with the government or local authority or statutory body. Entering with the corporation, with Gujarat State Corporation, like our Tamil Nadu Bus Depot Corporation, etc. Can they just enter it with the corporation and claim deduction? The answer is yes. They are a government body only, held by High Court. That GRCTC is wholly owned and by the government. It qualifies to be a government agency. It has fulfilled all the conditions. So, assessee can claim deduction under ATIA. Can unabsorbed depreciation of an industrial undertaking be set off? Because business loss cannot be set off. Inside the period only it should rotate. Can unabsorbed depreciation? Yes. Held by High Court that where there is a loss from eligible business, then section 80IA become inapplicable. Because you cannot set it off. Within that year you set it off. It cannot fall. The court held that in case of unabsorbed depreciation, the eligible business can be set off against non-eligible business. Where it is so set off, then in the subsequent year, your unabsorbed depreciation for eligible business becomes zero. If you have set it, it's a plain logic. If you have an unabsorbed depreciation, you can set it off against non-eligible business also, no problem. But once you have set it off, next year eligible business itself has profit. No, I have an unabsorbed depreciation carry forward. No, that has been used for a non-eligible business. It has been set off. Again, the question is out of focus now. Okay. This is an interesting question. I disallowed some expenditure of my eligible business. So you declared a profit of 80 lakhs. 20 lakhs disallowance came because of tedious default. Can ATIA be for 80 lakhs or 1 crore? The answer is 1 crore. Held by the High Court that increase or disallowance is revenue neutral. The law specifies the profit is allowed as a deduction. The profit is after making all adjustment. So, assessee can claim on the enhanced profit. This is the next important case law, Meghalaya Steels. Because previously what was happening is 100% of profits of the business is allowed as deduction. Shall I repeat again? 100% of the profits of the business is allowed as deduction. Profits of the business means what? Profit of the business means what? Is it only the profit of the particular activity? If I have interest, can I claim? No. Interest is IFOS. House property income? No. That is a different. Only from profit of manufacturing. So, can transport subsidy, power subsidy, interest subsidy received from government be treated as business income? Is this subsidies? The Supreme Court said these subsidies are for this business only. No doubt these are income, but these subsidies are for these business only. There is a direct link between the subsidy and the manufacturing activity, so assessee can claim. Held by the Supreme Court that subsidy or income which take the character of reimbursement of the cost incurred by the assessee. There is a direct link with the company's business, profit earned and these subsidies, between the profit earned and these subsidies. Hence, deduction can be claimed. Further, duty drawback is also having a direct nexus in the form of support of export. Duty drawback will also qualify. Okay, Meghalaya Steels, it has been twice questioned so far. Twice questioned. But of course, when the section was dynamic. This is also already questioned. From which year ATIB starts? From the year of trial production or from the year of commercial production? Okay, held by the High Court. It depends upon whether the product generated from the trial run or sold or not. Where it is sold, from the year of trial run, it is already over. If it is not sold, from the year of commercial production, already questioned. ATIB, because ATIB is in the last year, not very, just one read through. Listen once. Even if you don't remember the case law, you will remember the, you need not remember the citation, you will remember the judgment. Assessee failed to claim ATIB in the first few years. Can he claim in the subsequent years? Yes. What's wrong? He is unaware. His chart accountant has not told him that there is a benefit. Held by the High Court that the provision has nowhere stated that assessee, if he fails to claim in a year, the same will not be allowed for any subsequent year. Hence, AO cannot deny the deduction for subsequent year. It is similar to that Gujarat Road Transport Corporation. Can an agreement entered into by a firm with the state government and work done in pursuance thereof survive upon its conversion to a company and qualify for deduction? Held by the Supreme Court that assessee company qualified for deduction under 80A, being an enterprise carrying on the specified business pertaining to infrastructure facility and owned by a company registered in India on the basis of agreement with the state government, to which the assessee company has succeeded in law, because there is an amalgamation after conversion of the firm. Okay, sorry, there is a conversion. A partnership firm is converted into a company. Can I continue to claim 80IA because the firm only entered into an agreement with the government, not the company. The firm only entered into an agreement with the government. Can the company continue? Yes. Succession means the benefits will be available to the transferee company, transferee entity, as it would have availed by the transferor entity, assuming that nothing has been incurred. Just go through this once before your examination. Very once, I will make you remember this case laws also in my own style, okay, in our test process, small things, so that you will be more clear. A quick questioning and then we will go to NAA, AMT provisions. Question number 1. VKS Limited is engaged in developing and operating and maintaining infrastructure facility. The company is also engaged in the production of cement. Business of infrastructure facility was commenced in financial year 1819. I know immediately you will say, sir, up to 17 only it is not allowed. But old question, I only changed the date to make you understand something else. Something else. So leave around 1819 or 1516, take it as 1516 or whichever year. During the 3 preceding financial year, profit and losses are 1819, 1920, 2021, including freight subsidy. In Meghalaya Steel's case, it is held price subsidy is a business income. So it will qualify for 80IA. Further information. Cement manufacturing transferred cement of certain quantity for an aggregate price of 20 lakhs. If they have sold outside, it would be 25 lakhs. Profit of infrastructure facility has been arrived at after charging consumables which is purchased from a relative. The fair market value is only 7 lakhs. Compute admissible deduction under 80IA, giving working note for the reasons of treatment. Under section 80IA, assessee can avail for any 10 years 100% deduction out of the first 15 years of operation. It is not beneficial to avail in FY 1819 as there is a loss on infrastructure. So why do you avail it? Don't avail it. Don't avail it. It is not viable for you. You can have out of the first 15 years any 10 years. Okay? It is beneficial to start claiming exemption from financial year 1920. So 80IA, if suppose this question comes now, they'll give for 5 years or 6 years. Okay, it's an old question, came 3 years back. So I have not changed, I have changed the date accordingly. Okay, so you might think that 17, it started 17, but the question is an old question, examination question. I want to work out and show you a similar question may come for 5 years also, you know how to work it out. Because some adjustments are very interesting and you need to know, that's why. Financial year 1819. So our assessment year is 1920. Not availing 80IA. Profit of cement business. How much is that? 120 lakhs. Less loss of infrastructure. had assessee availed 80 IA, this loss cannot be claimed. So you have not availed, so you are claiming this loss of 100 lakhs. Net taxable income 20 lakhs for 80 IA. Lot of things you will understand. That's why I am taking up this question, even if it is an old question. Financial year 1920 AY 2021. Profit from infrastructure facility 60 lakhs. Profit from cement manufacturing 140 lakhs. Gross total income deduction under section 80IA 100% of profits of infrastructure facility. This is how you have to work out. Okay, first allow it and then give the deduction. This is a deduction, not an exemption. So first you will include it in income and then provide deduction. Total income. Financial year 2021, our assessment year 21-22, for the assessment year in which you are writing the examination. Okay. Infrastructure facility, and I want you to understand a lot of things. Profit as per P&L account 75 lakhs. Freight subsidy is directly having nexus with business conduct. Hence, according to Meghalaya Steel's judgment, freight subsidy will also qualify for deduction. So you need not reduce it. It is a business income only. We have been seeing right from K and Co. Margin money is for the purpose of business. Sri Rama Multi-Tech. You have to keep the share application money separately. It is to do with the business. Compensation is to do with the business. So it is a business income, no adjustment. But now, in our transfer pricing regulation itself, we have seen this. Sir, you have a cement division which is taxable, sir. 140 lakhs. You have to pay tax, compute tax and pay it. You have a cement division which is taxable, sir. And you also have an infrastructure division. If somebody XYZ goes and purchases cement from you, you sell them for 25 lakhs, make a profit of 5 lakhs. But To your infrastructure business, you are transferring the cement for cost price 20 lakhs. Why? Because if you earn profit in cement, you have to pay tax. If you earn profit in infrastructure, you need not pay tax. Government provides exemption for infrastructure industry. You are also manufacturing cement for which no exemption is provided. So, BEPS in a different format. You are shifting profit from cement division to infrastructure division because infrastructure division profits are exempt, cement division not permitted. What is the wording? Inter-unit transfer should be at fair market value. Less purchase price of cement inter-unit accounted at cement manufacturing aggregate 20 lakhs. Similar is available for them. Okay, accounted at accounted not at FMP. So my profit will go down by 5 lakhs. My profit should go down by 5 lakhs. Cement division's profit should increase by 5 lakhs. Not acceptable. Inter-unit transfer can only be at fair market value. Don't try to shift the profit and get benefit. That's why these are coming under domestic transfer pricing regulation. Not only here, very soon I will show you in some other places also. Okay. Section 48(2), payment to a relative in excess of fair market value. What is that? Purchase of consumable amounting to 10 lakhs, whereas the fair market value, this is your subsidiary company, whereas the fair market value is only 7 lakhs, so 3 lakhs. Profit increases. Profit before claiming exemption. How much? 73 lakhs. Can for this 3 lakhs exemption be claimed, sir? And for this 3 lakhs, because you said that this is an relative payment, so this is disallowance. For the disallowance, can the exemption be claimed, sir? The answer is here, my dear friends. The answer is here. Okay, we just saw Sunil Vishamrat Triwari. Even if there is a disallowance, you can claim it. You can claim it. Actually, yes. Okay, so 73 lakhs from the infrastructure industry. Cement manufacturing. Profit as per profit and loss account. Profit as per profit and loss account 1 crore. Add inter-unit transfer, not at FMV, adjustment made now, that 5 lakhs. Gross total income. Deduction under section 80IA. Disallowance are also available for deduction. Sunil, sorry, Vishwam Tiwari. So this 73 lakhs total income. So the main thing I want you to understand is Disallowance also gets the deduction, and inter-unit transfer 35 AD, 10 AA, transfer pricing provision. Don't use unfair methods of shifting profits. If the assessing officer does it, you know what will happen? He will increase 5 lakhs here. He will not reduce that 5 lakh here. So, only revenue friendly they will do and not assessee friendly. Anyhow, it's revenue neutral. I understand that. Question number 2. ABC Limited, a developer of SEZ, established in the previous year 1516. It exercised the option of claiming deduction from 1819. Received the following: income from maintenance of SEZ allowed, lease rent of building allowed, that is also income. Okay, interest received from bank deposit from the refundable securities, this is IFOS not allowed. Calculate the deduction available for the company. On 1st April, it transfers the operation and maintenance of SEZ to another company. Now, DEF Limited want to claim 80 IAB in respect of the income derived from SEZ. Comment on the validity of law. Yes, they can claim. Yeah, the provisions will be available to the transferee entity as it would have availed by the transferor entity had the event did not happen. Provisions are applicable to the transferee entity as it would have applied to the transferor had the event not happened. Question number 3. Vikram commenced the business on 1st April 2020 with 350 employees. The details are 75 employees from 1st April 2020, 24,000. 125 employees from 1st May, 26,000 per employee. 50 casual employees, they will not be covered by Provident Fund from 1st August. 100 regular employees from 1st September, less than 240 days. Less than 240 days. Up to 1st August only taken. Regular employees qualify for RPF, whereas casual employees. Find out the regular employees, further, out of the regular employees, 100 does not qualify to be a workman. Nowhere we said they should be workmen. We have 4 conditions. Don't pay them by cash. Their salary should not exceed 25,000. They should be covered by RPF. They should have worked for 240 days. "75 employees from 1st April fulfill all conditions, hence qualify." How much? 75 into 24,000 into 12. 75 into 24,000 into 12. 125 employees from 1st May do not qualify as the salary exceeds rupees 25,000 per month per employee. Do not qualify. 50 casual employees do not qualify as they are not covered under PF. The 50 employees, casual employees, do not qualify as they are not covered under PF. 100 employees from 1st September do not qualify as the number of working days is less than 240. If you want, I can show you September, October, November, December, Jan, Feb, March. Okay, so they don't qualify. Total qualifying wages. Total qualifying wages is 2 crore 16 lakhs. Deduction under section 80 JJAA, 30% of qualifying or additional wages. Question number 4. Bharatwaj Private Limited declares a total income of 90 lakhs with turnover of 18-19 being less than 400 crores. Total income includes dividend from subsidiary company 18 lakhs. The company declared a dividend of 15 lakhs in August and pays it in September of the assessment year. Compute the income and tax payable. Will your answer change if the company has opted for alternative tax region? Okay, we will though we'll study later. I will answer some part of the question here. Computation of total income. Gross total income. Gross total income 90 lakhs. Deduction under section 80M. Dividend received. Okay, dividend received from subsidiary companies 18 lakhs. Dividend declared and distributed within 1 month prior to the date of due date of to the due date of filing returns, okay, is 15 lakhs. Whichever is less is allowed as a deduction, my dear friends. So total income is 75 lakhs. Either dividend declared or dividend declared and distributed within September 30th or dividend received, whichever is less. So cascading effect is avoided. Receiver paying dividend tax, again receiver paying dividend tax, this cascading effect is avoided. Note, okay, since the turnover of 18-19 is less than 400 crores, base rate is 25% and HEC 1%, because no surcharge, 75 lakhs only, so 26% is the tax. Okay, 80M can be claimed even if the assessee is opting for 115BAA optional tax regime. Okay, 80JJAA and 80M can be continued to be availed. Okay, even if you are following the optional tax regime, 80M can still be claimed. That is what is the amendment. When we come to optional tax regime, I will tell you again. So this can be claimed. Question number 5. Write notes on various types of dividend and its taxability. Dividend, taxable domestic dividend, taxable in the hands of receiver from financial year 2021. Interest on borrowings to the maximum extent of 20% of dividend can be claimed. Okay, this is about domestic dividend. This is about domestic dividend, my dear friends. Okay, right? deemed dividend taxable in the hands of the substantial interest holder, whoever it is, even if it are given to the firm or a company, still it is taxable in the hands of the substantial interest holder. No deductions can be claimed. No deductions can be claimed, and it is taxable even if you have repaid or paying interest, etc. No question of any. Okay, dividend from foreign company and cooperative society taxable in the hands of receiver. Collection charges and interest can be claimed. Okay, here it is from the first it is there, so this can be claimed. Collection charges and interest can be claimed. Okay, fourth one, if you don't remember, if you don't recollect, if you don't know, don't worry, I will teach you when it comes to. Okay, dividend from specified foreign company. Okay, a company in which Indian company holds 26% or more of voting power. Okay, I told you while doing the associated enterprise concept, 26%, it becomes a specified foreign company also. Dividend received is taxable at 15% under section 115 BBD. No deduction can be claimed. Special rates of taxation. எப்பயுமே 115. I'm always 115. No deduction can be claimed. Various types of dividend and its taxation. Domestic dividend, deemed dividend, foreign company, cooperative society dividend, and dividend from specified foreign companies. Okay, only one benefit is, you just saw that, since I'm writing as a consolidation, I will write it here itself. APM deduction only for companies, dividend received or dividend distributed on or before 1 month prior to the due date of filing returns is allowed as deduction. Okay, ATM is again for companies. ATM is only for companies, not for, of course, only companies can distribute. Okay, not for other associates. This. Okay, one last thing about dividend, I consolidate so that when you refer to this sheet, you are clear about the dividend. Okay, surcharge for dividend. Maximum surcharge for individuals and is only 15%. Even if the surcharge for other income is 25% or 37%, surcharge on dividend income can only be 15%. These are all the various dividend taxation. I have just summed up the dividend taxations for you. You have not taken it down. Today I will give you because I want to complete one chunk and give it to you. Otherwise, you will also not know which is international taxation. You have it as one chunk, one Excel sheet, everything. Here you will have everything from PGBP till AMT. So that assessments is a separate Excel sheet. Like that we will maintain, so that you will also not have too much of Excel sheets and get confused at all. We have sufficient time to complete the last arena, that is AMT provisions. Okay. Okay. I think, yeah. AMT provisions. What is AMT? Alternative minimum tax. This is for non-corporate assessees. For companies, it is MAT for non-corporate. Before going into, let us understand what is section 10AA. Export profit, because I have been telling you, export profit 80IA, 35AD. One you are claiming, other two you cannot claim. Let me complete the third thing also before going to assessment. Okay, it is like stacking all the arrows in our basket, so that we know very clearly when we go to assessment of entities which arrow to take. Brief over. Available for all assessees for the export oriented units which are there in SEZ. For what purpose you are giving? Because you are bringing me forex, I like to give you export profit as exemption. Because you are bringing me forex, because you are bringing me forex, that is important. So what is export turnover? It is not what you have exported, it is what you have brought in. It is not what you have exported, it is what you have brought in as a foreign currency. Because the exemption is for you bringing foreign currency and not you exporting goods. Export turnover means money brought into India in convertible foreign exchange within 6 months from the end of the financial year. Sometimes RBI allows you to retain the money there, don't bring it because you have some payments adjusted there, balance of payment. Okay. So exemption, export turnover means money brought into India within 6 months from the end of the financial year, or money retained outside India with the approval of RBI. What is the exemption? First, what is export profit? Total profit into ET by TT. Total profit into export turnover by total turnover. What is export turnover? Money brought into India within 6 months from the end of the financial year. Quantum of exemption 100% for the first 5 years. Next 5 years 100%, 50%. Last 5 years, if you transfer it to reserves, leave that. The first two, if you understand, enough. Introducing to you now alternative minimum tax, because unless you understand 10AA, which we will work our solutions also, don't worry. AMT is only for non-corporate assessees. Okay, only for non-corporate assessee who enjoy profits as per books but were claiming exemption. Okay, so honest person should say, okay, right. How to compute AMT? Okay, AMT is applicable only if the adjusted turnover exceeds 20. I will tell you what it is. This is the format. Compute the total income after providing for all allowances, expenditure, exemption and deductions. Once more, compute the total income. Add one exemption, one type of deduction and one expenditure. Repeat. Add one expenditure, 35AD, one exemption, 10AA, one type of deduction, income-based deduction, especially ATI. Less depreciation on assets, because here you have some assets. Less depreciation on that asset, you will get adjusted total income. An assessee is liable to pay normal tax or 18.5% of adjusted total income, whichever is high. If the assessee is located at IFSC, we already saw the benefit. It is only 9% of adjusted total income. Read through. You will add back one expenditure 35 AD, one exemption 10 AA, and a set of deductions mostly 80I. Whatever is 35 AD has, or everything as asset claimed as deduction. We saw, except land, goodwill and financial instruments, all assets can be claimed. So whatever is the depreciation for that asset you allow it, you will get adjusted total income. If this exceeds 20 lakhs, then it is applicable for individuals and other things also. 18.5% of adjusted total income or normal tax, whichever is higher, is payable. And you will get something known as tax credit under 115 JD. I will work out solution and tell you. This is essential for you to understand partnership. That's why partnership and future chapters. A sole proprietor commenced the business which qualifies for deduction under 35A. The total investment in plant and machinery is 100 lakhs. The sole proprietor earned the total income from the said business after providing for deduction under 35 AD, before providing for deduction under 35 AD, 80 lakhs. This apart, he has income under IFOS 25 lakhs. Compute tax. Read through. business or profession, net profit before claiming 35 AD is 80 lakhs. Is 80 lakhs. Yes. Expenditure under 35 AD. The question says 1 crore. 100 lakhs he has spent on plant and machinery. So this can be claimed. The total investment is 100 lakhs, 1 crore, which can be claimed. Loss from specified business. Loss from specified business is 20 lakhs. Unfortunately, this can only be carried forward. To be carried forward, it cannot be set off against my other sources. Loss from specified business can only be carried forward. It cannot be set off against my other business. Other sources, interest income or whatever it is, 25 lakhs. Gross total income / total income is 25 lakhs. Gross total income or total income is 25 lakhs. Computation of tax. Computation of tax. Please understand, base tax 25 lakhs minus 10 lakhs individual, okay? 15 lakhs into 30% plus 1,12,500. 15 lakhs into 30% plus 1,12,500. Add HEC at 4%. Total normal tax payable. Total normal tax payable is 5,85,000. Total normal tax payable is 5,85,000. Computation of adjusted total income. Computation of adjusted total income. Total income as per normal provisions. Total income as per normal provisions 25 lakhs. Total income after all expenditure, deductions and exemptions 25 lakhs. And expenditure under 35 AD, we claimed 1 crore. Because of that only there is a loss, 1 crore. Less depreciation at the rate of 15% on such capital expenditure which is claimed under 35 AD. So I have to claim, I can claim on this 15%. The question itself says 15%. Adjusted total income. Adjusted total income 1 crore 10 lakhs. Adjusted total income 1 crore 10 lakhs. If the, for an individual, if the adjusted total income is more than 20 lakhs, I need to compute AMT also. I need to compute AMT also. Okay, okay. Computation of alternative minimum tax. Base tax at 18.5% of ATI, adjusted total income, into 18.5% base tax at the rate of 18.5% of ATI, and surcharge at the rate of 15% individual, the total income exceeds 1 crore. So this into 15%. This into 15%. The total income has exceeded 15 crores. Okay, 1 crore. And HEC at the rate of 4%. HEC at the rate of 4%. Total AMT, total alternative minimum tax, 24 lakh 33,860. 24 lakh 33,860. Please understand this. A non-corporate assessee is liable to pay tax at normal rates, which we all know is 5,85,000. Tax at AMT, okay, whichever is higher. So a non-corporate assessee is liable to pay this much, okay, this much, okay, according to section 115 JD, where AMT is paid. So in this case, AMT, the difference between AMT and normal tax can be carried forward as tax credit. So what will be the tax credit in this case? This minus my normal tax. Okay, 1848,860. This carry forward of tax credit can be adjusted against normal tax payable. This carry forward, whatever carry forward you have, can be adjusted against normal tax payable. Okay, maximum period of carry forward 15 AYs. So what is the base reason for implementing AMT? Only one reason, collection of tax. Because people were claiming 10 AA exemption 35 AD, they want to, when companies have MAT, why should not partnership firms and others pay? I accept with you, it is not right manner, but what to do? Question number 2. Pqr LLP set up a unit in special economic zone in the financial year 2014-15. In the financial year 14-15. In exam also, count and see 14-15, 15-16, 16-17, 17-18, 18-19. First 5 years over. So now you can only claim 50%. First 5 years over, next 5 years 50%. The unit fulfilled all conditions of 10AA. During the financial year 1920, it has set up a warehouse facility in Tamil Nadu for storage of agricultural produce, which fulfills all 35 AD. Capital expenditure in respect of warehouse 75 lakhs, including cost of land 10 lakhs, which is not allowed. 65 lakhs can be claimed. Warehouse is a building 10%. The warehouse became operational in the current year and the expenditure was capitalized. Relevant details are profit of SEZ, export turnover, domestic turnover. Profit of warehousing before considering 35 AD. Compute income tax payable by the LLP for the financial year. Read through. Export oriented unit, net profit is 40 lakhs less exemption under NAA. Okay, export total profit into TT by TT, export turnover by total turnover, into 50% as it is in the 7th year of operation. If it is first 5 years, 100%. Okay, next it is 7th year of operation. So 40 lakhs into export turnover is 80, total turnover is 100 in lakhs. 80 lakhs into 100 divided by 100 lakhs into 50%. Okay, 40 lakhs into 80 by 100 into 50%. This is my exemption, so that I get the income of 24 lakhs from export oriented unit. From export oriented in unit, I get an income of 24 lakhs. Specified business. Specified business. Profit before claiming 35 AD. Profit before claiming 35 AD, 1 crore 5 lakhs. Yes, 35 AD expenditure. 35 AD expenditure. 75 minus 60 minus 10. Okay, land cannot be claimed. Land cannot be claimed, only warehouse expenses. Okay, so it comes to 65 lakhs. So that my total income My total income is 64 lakhs. My total income is 64 lakhs. 64 lakhs. For a firm, the tax rate is flat 30%. Flat 30% and surcharge is 12% if income exceeds 1 crore. Tomorrow we will see. So 64 lakhs into 30% add HEC. Okay. Let us compute the adjusted total income. Let us compute the adjusted total income. Total income as per normal provision 64 lakhs. Add expenditure under section 35 AD 65 lakhs. Okay. Exemption under section 10AA. Exemption under section 10AA 16 lakhs. Less depreciation at the rate of 10% on warehouse. Okay, it's a building. I asked you to remember for building and all 10%, plant and machinery 15%, computer, intangibles, those small rates, please remember. Adjusted total income. One crore 38 lakh 50,000. 1 crore 38 lakh 50,000. Total income is the base point. Add expenditure under 35 AD. One expenditure, one exemption, deduction. Okay, the surcharge will be 12%. The surcharge will be 12%. Okay, the surcharge will be 12% if income exceeds 1 crore. Okay, this will be into 12%. Okay, so 18.5% is my 18.5% is my tax. Okay, 3,07,000 surcharge and 1,15,000. The conclusions goes in the same way. Okay, take your time and just displaying it. AMT, when should your mind think to do AMT? Shall I repeat the question? When should your mind think to do AMT? Three cases. If there is expenditure under 35 AD, remember. If there is exemption under 10 AA, deduction under 80 IA. Okay. So please remember, your mind, you train your mind, you tell your mind, I should check for AMT. Other cases you need not check. When should you check for AMT? If there is it is a non-corporate, not a company. 35 AD is it there? 80I is it there? 10 AA is it there? If the answer for any one is yes, you will check AMT. Otherwise, long time since they questioned AMT and all, but still, I think it's a questionable. Question number 3 is similar to the question which we worked out. I want you to do it and check the answer once so that tomorrow morning we can go for assessment of firm. Once please check the answer after doing question number 3, similar question only. You can check the answer. Take it as a homework, do it and check the answer. 1.